profit. This is BD Traders. Statement of adjusted profit for the year. The year is 30th September 2023. Now, candidates, the accounts of BD Traders was prepared by an inexperienced accountant who made the errors that we have identified. As a result of these errors, the reported profit was not correct. It was incorrect. And looking at the statement of financial position, you can see there is a net profit there of 126 million. That profit is not correct because there are some errors that affected the income statement. The net profit is a byproduct, is a result of the items that are prepared in the income statement. For example, you can see there was an error in purchases, which is part of the income statement. There was an error with that affected the repairs. There's an error here, sales, that affected the preparation of profit. Another error is drawings that affected the preparation of the income statement. The bad debt also affected the preparation of the income statement. So we're going to have two columns here to prepare, to correct the net profit. This is the reported net profit. The inaccurate profit is 126. Is it 126 million? Yes, 126 million. This profit is not correct. We need to adjust it. We are going to adjust it by, first of all, adding the errors that understated it, the understatements. Add back under. Let me just call them understatements. The items that understated it. Then we will deduct the amounts that overstated it. Then lastly, here we'll have the corrected net profit, the adjusted profit. Now, looking at the errors, look at error number 1. Purchases day book had been undercast by 2.8 million. When you undercast purchases, what effect does it have on the net profit? That is the question. Because purchases affects the net, is one item that is used in preparing the preparing the income statement. So purchases were understated or undercast by 2.8 million. So what is the effect of this error on this profit? So this first error overstated the profit. So we are not going to add it, but we will deduct it. Then the second item, an item of equipment costing had been debited to the repairs account. Had been debited to the repairs account. That means the expenses were more. The expenses were more. When you overstate the expenses, what effect does it have on profit? It understates the profit. So we are going to add these repairs. Why? Because by increasing repairs or by increasing expenses, that reduces the profit. So we add back. The amount is 2.6 million. Now, on the same note, number 2, we have depreciation on equipment, which is charged at the rate of 15% per annum. That is depreciation, which is an expense. As a result of this error, depreciation was not recorded in the statements for the equipment that was debited in the repairs account. So that is an error which states because depreciation is an expense and it was not recorded. The question is, what is the effect of this omission on the net profit? So it overstated the profit. So we are going to deduct. That one will record it later. Point number 3, a debit balance of 2.4 for data had been omitted from the total accounts receivable. Accounts receivable is not an income statement item, so we skip it. Point number 4, an entry of 2.1 million for return outwards was made in error in the sales book instead of purchases returns day book. Do you understand? So there was an error in purchases and also an error in the sales day book. That is 2.1 million. An entry of 2.1 million for return outward was made in error in the sales day book. That means the sales account here was overstated. At the same time, the purchases account was understated with the same amount. So the two will cancel out, and therefore there was no point of adding back and removing the same amount. So that one we ignore it, does not have an effect on the net profit because the same amount will be added and the same amount will be deducted. So we ignore it and move on to note number 5. A check of 2,250,000 was paid to a creditor. Creditor's error in creditor's account does not affect the income statement, so we ignore it. Number 6, goods valued at 220 were withdrawn for personal use, but no entry had been made in the books. You recall that that is an error of omission here. Purchases ought to have been reduced. The effect of that error is that purchases were understated because it was an omission. So because it is a drawing and it reduces purchases and that transaction was not made, that means that the purchases as they appeared in the statements were overstated because the drawing was not reduced. Purchases were overstated. So when you overstate purchases, that has an effect on the net profit. When purchases are overstated, then the net profit is reduced, and therefore we add back the drawings. The amount is 220. 220. Then note number 7, a bad debt of 1,250,000 was yet to be written off from the accounts receivable. Was yet to be written off. Bad debt is an expense, so it was omitted. When an expense is omitted, then that expense overstates the profit, and therefore we will deduct it down here. Then that is note number 8. Note number 7. Note number 8 reads, a discount received of 590,000 shillings had been correctly entered in the cash book but had been posted to the wrong side of the discount received account. Was posted to the wrong side. That means that the profit was understated because discount is an income. It was not recorded. It reduces the net profit, and therefore we add back the discount. Discount received should be added back 1180. So these three items understated the net profit, so we add back. Then we less overstatements. We reduce the overstatements. Let's go back to note number 2. Depreciation on equipment is charged on that amount. That depreciation of 15% of the 2.6 was omitted. Now, when expenses are omitted, that has an effect of increasing the net profit. Therefore, we reduce that depreciation. Depreciation on equipment, that 15% of 2.6, 15% of 2.6, 390. This overstated the profit, therefore we remove it. That is note number 2. Do you have any item that overstated the profit? Note number 1, purchases day book had been understated. Purchases day book had been understated. When you understate purchases, the amount overstates the profit, and therefore we remove it. These are purchases of 2.8. That is the first item. The first error overstated the profit, so we deduct. Then I'm checking for any other error that may have overstated. We recorded depreciation. We have recorded the purchases. Then there was note number 7, a bad debt of 1250 was yet to be written off. This is an expense that was not written off. This expense overstated the profit, so therefore we deduct the bad debt. Bad debt of 1250. Bad debt of 1250. So we are going to adjust the profit with the understatements and overstatements. The total here is 4,000. We add to that. Then we deduct 390 plus 2800 plus 1250. 4440 deduct the adjusted profit 125,560,000. That is the adjusted profit, net profit. This is part C. This is C of the question. D, a corrected statement of financial position as at 30th September 2023. BD traders, we are having here the corrected. The question is corrected statement of financial position. BD traders corrected statement of financial position as at 30th September 2023. We begin recording the non-current assets cost, depreciation, net book value. Checking from the statement provided, we have plant and equipment. Plant and equipment. Plant and equipment. Candidates, the cost there is 634 million. Then in note number 2, there is an item of equipment costing 2.6 that had been debited to repairs account. This item ought to have been debited in this account, but it was omitted. So we are going to add the 2, that is 634 provided in the statement. We add the amount that was omitted in note number 2, 2.6 million. 2.6 million. So the new cost here is 636,600. The accumulated depreciation, candidates, will be the depreciation provided in the statement, accumulated depreciation of 72 million plus the depreciation for the item that was omitted. That will be 72 million from the statement. This one does not need any calculation. 72 million is the accumulated depreciation as at this date. Then there was depreciation that was omitted. This depreciation on equipment of 390, we had already calculated it, plus 390, that is the accumulated depreciation, which is equal to 72,390. The net book value will be the difference between this and that, which is equal to 636,600. The net book value here for plant and equipment, 564,210. 564,210. That is plant and equipment. Then you have furniture and fittings. Furniture and fittings. Cost is 70 million. 70 million is the cost there from the statement. Then there were no adjustment in fittings. We have depreciation there, 14 million. Then the difference from the question is provided. There was no need to calculate. This is 56 million. You can see candidates, you may miss a calculation, but there are items which can earn you free marks, like this furniture and fittings. I've copied directly from the question, the cost, the accumulated depreciation, as well as the net book value. So here there are only two non-current assets. So we get this total there, close it, get this total, close it, get this total, don't close. So these are non-current assets. Current assets, we check current assets from the question. First current asset, inventory. Inventory is valued at 28 million. The next asset is accounts receivable. Accounts receivable. Now, the accounts receivable candidates, the amount is 57 million. This figure is not accurate because there were errors that affected the accounts receivable. The first error is number 3, a debit balance of 2.4 million for data had been omitted from the total accounts receivable. Was omitted. If it was omitted, then we add back 2.4 million. We add back the 2.4 million. Then there is an error in number 7, which says a bad debt of 1250 was yet to be written off. Was yet to be written off. So if it was yet to be written off, then write it off 1250. So that will give us the right amount. So the amount here is 58,150. That is the right value for accounts receivable. Then do we have any other current asset here? No. So these are non-current assets. We add the non-current assets. Let's first of all add the current assets. Non-current assets, we have 620, 210. Then we add the depreciation, 86,390. We add these two, 706, 600. We add the current assets, 86, 150, plus these are current assets plus non-current assets. Add non-current assets, 706,360. So this total assets. Total assets. These total assets are financed by capital and liabilities. The capital is 694 million. 694 million. Then we had the adjusted net profit. The adjusted net profit, 126,560. 126,560. Then we deduct drawings. Drawings, candidates, we need to adjust because there was an amount that was not included. The drawings from the statement, drawings we see there is 160 million. In note number 6, goods valued at 220 were withdrawn for personal use, but no entry had been made in the books. No entry had been made in the books, and therefore the drawings will be equal to the 160 million plus the 220 plus 220. That is the drawing. So we have, which is equal to 160,220. That is the drawing in bracket. Then we have liabilities. The first liability, accounts payable. Now the accounts payable is valued at 50 million, which is not the accurate figure, because in note number 5, a check of 2,250,000 paid to creditor was correctly entered in the cash book, but credited into the wrong creditor's account. So we are going to deduct this amount. Was 4,500. This amount, we deduct it from the 50 million. So we'll have 50 million minus the 4.5 million. 50 million minus 4.5 million. 45,500,000. That is accounts payable. Then another liability is a bank overdraft. We have a bank overdraft. You can see, candidates, the bank balance is shown below the accounts payable, which means that is an overdraft. It is on the credit side of the balance sheet. That is an overdraft of 1520. So these are the liabilities and capital. So let us add 694 million. This net profit should be 125. This is 125,560. 125,560. Then we add 694, 125. Seven oh six three 706,360. This is the total liabilities and capital, which is equal to the total assets. So candidates, we've answered this question that was tested in December 2023. We've done part A, B, C, D. A, B, C, D. So this is how to earn the marks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Here, candidates were to earn 8 marks. So each entry, half a mark. Then part B is only 2 marks, suspense account 2 marks. 1, 2, 3, 4, 5. These are 2 marks. Then the statement of adjusted profit. Statement of adjusted profit is 4 marks. 1, 2, 3, 4, 5, 6, 7, 8. Then lastly, we have the correct statement of financial position. Correct entries 1, 2, 3, 4, 5, 6, 7, 8, 9. So candidates, I urge you to check from our revision partners. We've done several of these questions. Practice these questions. Take similar questions from the past papers. Answer the questions. We've answered these questions in our revision books. We've also answered all these questions in our video lectures. So you have enough resources to help understand the skills in accounting, and particularly this topic on errors. So thank you for attending the lesson. God bless you. Bye-bye.
Hello learners, welcome to Manifested e-learning platform. My name is Jobash, and I'm going to take you through quantitative analysis, the examination by Kasneb under foundation level 2. Now we are going to look at the solutions in respect to August 2023, that is the last sitting. Now we are going to start with the question number 1. Question number 1. Question 1. Question number 1. Let me start with what? Part A. Question number 1, part A reads, explain the meaning of the following terms as used in decision theory. So the first terminology you are told to explain is decision alternative. 2 marks there. And then we have another one, Roman 2, state of nature. Also 2 marks. Roman 3, conditional payoff. 2 marks again. Then Roman 4, opportunity cost. 2 marks. So my good people, allow me to start with Roman 1. Roman 1 is decision alternative. Decision alternative. So we can just explain that. We can say decision alternatives, these are options available to a decision maker. These are options available to a decision maker of which he will select the best. That is what we mean as what? Decision alternative. They are what? Decisions or options. They may be more than 2, so that you can select one which will prevail or which will promise you the highest return. That is what we mean as what? The decision alternative. Roman 2 is state of nature. State of nature. State of nature. My good people, state of nature, it means that they are circumstances. They are circumstances which are beyond control of a decision maker or management. They are circumstances that are beyond the control of a decision maker. So there we can say these are circumstances that are beyond control of a decision maker or management. For example, we can say competitors' reaction. Competitors' reaction, natural calamities, demand, that is market demand market, etc., etc. So those are what we call what? The states of nature, circumstances beyond control of a decision maker. They are out of discretion. Good. Let's look at Roman 3. Roman 3, they are saying a conditional payoff. Conditional payoff. So you find that these are the payoffs which occur. They are the payoffs which occur or accrue depending on the previous occurrence, depending on the previous occurrence or the prior occurrence from a given branch. So we can say there they are payoffs that accrue from a given branch, but depends on the previous or prior occurrence. That is what we mean as what? As the payoff in respect to conditional. Roman 4 is the opportunity cost. Opportunity cost. Opportunity cost, my good people, it means that they are the penalties. They are the penalties that a given decision maker bears as a result of foregoing, as a result of not choosing the best course of action. So we can say there, we can say opportunity cost, it is the payoff, it is the penalty, you can say the penalty stroke regret that a decision maker bears as a result of foregoing the best course of action. Like that. So that is what we call what? The opportunity cost. Opportunity cost. For example, if maybe, for example, branch A gives us what? Maybe 5,000 as the penal, as what? As the payoff. Then B gives us 7,000. C maybe 3,000. So in that case, the best alternative in this particular scenario is B. So therefore, if you forego B and maybe choose A, then the difference between the payoff of B and the payoff of A is what we call the regret or the opportunity cost. That is the penalty of not choosing the best course of action. I believe that is very clear. That is very clear, my good people. So at that point, we are going to give you 2 marks each. 2 marks each. Like for example, here the first one, you are given 2 marks of explaining. 2 marks like that. That's how we mark 2 marks. Good. That is it. That is it about part A. Now let's look at part B. Part B. Part B, you are told there, the following data relates to the ages of 100 students attending a workshop on personal branding organized by the student welfare officials of Bride Business College. So you have the column for age in years, you have below 20, then we have between 20 to 25, 25 to 30, 30 to 35, 35 to 40, 40 to 45, 45 to 50, and then above 50. Then we have the column for number of students. Number of students, we have 2, 4, 10, 20, 32, 18, 10, and lastly 4. Thereafter, 15% of the youngest students and 5% of the old students attending the workshop were selected to attend a further training on curriculum vitae writing. You are required there, Roman 1. Determine the youngest age of the students selected to attend the training of curriculum vitae writing. 4 marks there. Roman 2, determine the highest age of the students selected to attend the training of curriculum vitae writing. Again, you are awarded 4 marks there. Roman 3, calculate the median age of the students who remained after selection of students to attend the curriculum writing. 4 marks again, as you can see there. So in that case, you must have garnered 20 marks of that particular question 1. Now let's look at that Roman 1. So we are solving part B, Roman 1. Part B, Roman 1. You are told determine the youngest age. So my good people, this is a concept which is tested from descriptive statistics as a subtopic based on quartiles. We have quartile, we have percentiles, we have deciles. So this is based on what? Quartiles. So the youngest, that means it is quarter 1. Quartile 1 per se, quartile 1. Then Roman 2 is the highest, that is quartile 3. Then Roman 3 is the median. Good. Now let's solve that particular Roman 1 of part B. So at that point, you have to quote quarter 1. How do we get quarter 1? Quarter 1 we get as what? The summation of f, that is the frequency, divided by 4, because it's a quartile, then you multiply with 1, like that. Good. So we have our table here. Let me have the age. I have the age in years. So let me write below 20. Then we have 22, 25, 25 to 30, 30 to 35, 35 to 40, 40 to 45, 50 to 55, 40. That is 50 and above, and above, like that. Then I have the column for number of students. Which I can denote as what? As frequency. Number of students being the frequency. Okay. Now let us plug the figures to the respective ages. That is the frequency. The first one is 2, followed by 4, 10, 20, 32, 18, we have a 2, 4, 10, 20, then we have 32, we have 18, that is in respect to what? 40 to 45, that is 18. Then we have, we had here 45, let me come back here, we have 45 to 50, and then we had what? 50 and above. Good. So we have 18, that is, then another frequency is 10 for the range of 45 to 50. Then lastly, above 50, the frequency is 4. All right. Now we have to have a column for what? Cumulative. Cumulative frequency. Cumulative frequency. Okay. So cumulative frequency, my good people, we start with the 2. That is the first one. So 2 plus 4 giving us 6. 6 plus 10, 16. Good. 16 plus 20, that is 36. 36 plus 32, 68. 68 plus 18, that is 86. 86 plus 10, good, that is 96. Then 96 plus 4 giving us 100. And that one means that the number of students that we were in respect to this particular exercise was 100. So the cumulatively must add up to what? Must add up to 100. Like that. Now, Roman 1, we are told to do what? To determine the youngest age, which is what? Quartile 1. And that is the formula on how to get what? The quartile. So this one, I'm going to say it is summation of frequency, which is what? This one, we get as what? 100, if you add them. So I'll have what? 100 divided by 4, then times what? 1. So that one will give us what? That one will give us, is it 25? 100 divided by 4. Yes, 25. 25, like that. So, how do we get the quartile 1? Quartile 1. Let me come on this side. Quartile 1. So, quartile 1, it is gotten by LM. That means the lowest boundary. The lowest boundary in respect to what? In respect to that particular quartile 1. So in this case, let me have my quartile, 25. Where does my 25 fall in respect to cumulative? 25 falls in respect to what? In respect to 36 here. So I'm going to circle like that. So that is what? That is our quartile 1. This is quartile 1, quartile 1 per se. So the lowest boundary in that mean or the quartile is what? Is 30. That is the lowest. Hoping we are together. Then I add open bracket summation of f in respect to 4 times 1 minus cumulative frequency. This cumulative frequency, it is the cumulative frequency which is above the quartile range, above the quartile range. So in that case, the cumulative frequency, because this is my quartile range, quartile 1 range, the cumulative frequency which is above that range is 16. That is what we mean as what? Cumulative frequency. Then I divide by actual frequency of that particular quartile. That is the actual frequency of the quartile 1. Then at that point, I multiply with what? With CI. CI stands for confidence interval. Confidence interval in that particular range is what? Is 5, because it's 30 minus 25. So 30 minus 35. So the range, the confidence interval is, or the width is 5. Good. So let us have the figures now. So the lowest boundary is 30 plus this summation I've done here is 25. So I have 25 minus cumulative frequency above the quartile range, which is 16, I said. I divide by the actual frequency of that quartile, actual frequency, 20. So I divide by 20, then I multiply with 5. I multiply with 5. That is the confidence interval or width. So let us have the figures there now. So 25 minus 16, I have 9. I divide by 20, I have 0.45. Then I multiply with 5, I have 2.25. Then lastly, 30 plus that answer equal sign. It is 32.25. So approximately that is what? 32 years. 32 years. We have solved Roman 1, where we are told determine the youngest age of the students selected to attend the training on curriculum vitae writing. That is it. And at that point, you have what? You have your 4 marks there. You have your 4 marks where we do what? Here we give 1 mark, and then formula 1 mark, 1 mark, and then lastly, that one gives you 4 marks. Roman 2. Roman number 2. Determine the highest age of the students selected to attend the training on a curriculum vitae writing. 4 marks again. Write the formula or determine first of all the quartile 2. Or not 2, that is the highest, meaning it is quartile 3. It is quartile 3 because it is the highest. That one, how do we get? We get the summation of the frequency divided by 4 because it's quarters. Then I multiply with 3. So that one will give me what? We have what? We have 100 out of 4. That one gives us 25. Then I multiply with 3, which will lead to what? To 75. To 75. Good. Now, 75. Where does the 75 fall in our cumulative frequency? Good. So where does it fall? 75. 75 falls in this range of what? In the range of 86. So you circle like that. So meaning that is our what? Our highest, which is quarter 3. Quarter 3. Good, good. Let us now have what? Have the formula there. So that one means quarter 3, we get as what? The lowest boundary in that quarter range plus into bracket summation of f divided by 4 times 3 minus cumulative frequency, which is above that particular what? That particular range. Then I divide by actual frequency, then multiply with what? Confidence interval, or sometimes called class interval. Good. So this one gives us, let us now have the figures. The lowest boundary is what? Is 40. Can have there from that particular quarter 3 range is 40 plus open bracket. Summation here will be what? Will be 75. We have done there the calculation so far. Then minus confidence interval. Not confidence, but the cumulative frequency above the quarter 3 range, which is 68. 68. It is the what? It is the one which is above. So we have what? There 68 divided by the actual frequency, which is 18. Then lastly, I multiply with what? With 5, which is the class interval or class width. So this one will give us, I have my calculator here, 75 minus 68 divided by 18 times 5 Then lastly, 40 plus the answer I have in my screen here. That one is what? Is 41, 41.9, 41.94. Recurring, 4 is recurring. So, therefore, that one will give what? Will give us what? 40 approximately. If we can round off to the nearest age, is what? Is 42 years. And at that point again, you have what? You have your 4 marks. You have your 4 marks there, and that is how we mark. We have what? We have this is 1 mark, 1 mark, 1 mark, and then lastly, like that. Now we move to part C. Part C, you are told calculate the median age. Calculate the median age. Good, good, good. So I'm going to come on this side, my good people. Let me come to this side again. So Roman 3, median. Median, my good people, median, we are going to have the formula, the connecting formula, which is the lowest boundary plus into bracket summation of f divided by 2. We are told it is what? It is the median. So we that quarter or that summation of hours, we divide by 2 so that we can get what? The median. Minus cumulative frequency, which we said it is the one which is above the median range, divided by actual frequency. Then I multiply with the class interval or class width. Good, 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 good. So at that point, what am I going to get as what? As f over 2. That is 100 divided by 2, giving us 50. So 50, where does 50 fall in our cumulative frequency? In our cumulative frequency, 50 falls in the range of what? 35 to 40. So that is our what? That is our median. That is our median. Good. So this one gives us the lowest boundary is 35. 35 plus into bracket summation of f divided by 2, we got to be 50 minus cumulative frequency above that median range, which is what? Which is 36. I can see there 36. I divide by the class interval 5. Sorry, no, is what is there? Is I divide by actual frequency per se is 32. Actual frequency 32, but the class interval is 5. So let us have that particular what? Solution. So it is 50 minus 36. I divide by 32 times 5. Then 35 plus that answer, I have 37. 37.1875. So that one is approximately, I can even round off to what? To 37 years. And at that point, you have also, again what? 4 marks to that particular Roman 3. 1 mark there, 1 mark, 1 mark, and then like that. So my good people, that one brings us to the end of question number 1.
Part B of the question I read, Fila Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. The second sentence, the machine costs 13,950,000. The firm will incur installation cost of 450,000 shillings. The machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. The overhaul will cost 1,125,000. After 6 years, the machine could be disposed of for 900,000 shillings. The company estimates that it will cost 2.1 million per year to operate the new machine. The current manual production method costs 5,250,000 per year. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. The company realizes a contribution margin of 45 shillings per unit. Additional information: number 1, the company applies straight line method of depreciation. Number 2, corporation tax rate is 30%. Number 3, Fila Limited requires 20% return on all investment. That should be on all investment and not an all investment. Required using NPV project evaluation method. Advise Fila Limited on whether or not to purchase the machine. Now, questions on capital budgeting can be easy, but they can also be a bit tricky. Okay, and you cannot say you have mastered capital budgeting because the questions can be varied. Like this one has never been set this way before. The one you are going to sit may be totally different, even if you understand this one today. But it's important for you to get the concept. And I've always said, when you have such a question, step number 1, what are you supposed to do? The first thing to do. What should you do first? Step number 1. Yes, capital budgeting is not a joke. It is not a joke, Willis, because of the nature of the decisions that are made in capital budgeting. As a finance manager, you are required to help the company make such decision. It's not a joke because money that is invested in a capital project is quite substantial and significant, and therefore there is no joke when you are dealing with such kinds of money. In working capital management, you are dealing with the day-to-day expenditure. This question, okay? Working capital, we are referring to paying of day-to-day expenses. But in capital budgeting, a decision that is made in capital budgeting, if you make a mistake, then that can lead to corporate failure. That's why even questions in your exam are quite, but is be that as it may, I'm saying, when you have such a question in the exam, you can see the question is 12 marks. These are many marks. You need to try and score at least 10 or at least 6 marks out of this question. As much as the question may look technical, you can still score some marks. Now, when you have a question like this one, just like the other one, the first thing to do is to put down the formula using NPV. What's the formula? NPV. Formula, net present value. Net present value, you are just comparing two things. The money that comes in and the money that goes out. Then you get the net. Okay? So, this one is constant. The formula is constant, net present value. It doesn't matter the level of complexity of the question. The formula still remains the same. So, NPV is equal to the summation of present values of cash inflows, of cash inflows minus the present value of cash outflow. In capital budgeting, is just the initial investment. Initial investment. Present value of initial investment. Initial investment. So that's what you do first. Is that clear? Formula. Then it is from this formula, then you can be guided on what to do. From this formula, we know we just need two things. Present value of cash inflows, and a question may have one inflow or multiple inflows. So you will have to aggregate all the inflows. Then you subtract the initial investment from the inflows to get the net. I think that is quite easy. Are we clear up to that point? Are we clear? That is clear. We just need two things. Then we get the net to get the answer. Anything else that we are going to do is just under workings. Any calculation we are going to do, those are workings. You understand? So, what are the cash inflows? What are the cash inflows? Once you have the formula, then you can proceed. We identify the cash inflows from this question. We read the question that Fila Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. That sentence, there is no inflow, is it? No. Second sentence says the machine costs 13,950,000. That is not an inflow, that is an outflow. Then we read the firm will incur installation costs of 450,000 shillings. That is an outflow, it's not an inflow. The next sentence I read, the machine will have an economic life of 6 years but will require an overhaul at the end of the 4th year. Will require an overhaul, and the overhaul cost will be 1,125,000. That is an outflow. Then we read after 6 years, the machine could be disposed of for 900,000. Will be disposed. When you dispose a machine, is that an inflow or an outflow? Can you answer that question? When you dispose a machine, yes, that is an inflow. So the 900,000 shillings is an inflow. It will be part of this. That's why I put here summation. That is one of the items we need. So we have it. 900,000 shillings. In financial management, what is the name we give to these 900,000? What is the name of these 900,000. Abraham says working capital. Is that true? Salvage value. Salvage value. Everyone is saying salvage value. Abraham says disposal value. What did the examiner call it? The machine could be disposed of 900,000. In technical terms, that is what is referred to as terminal cash flow. Terminal cash flow. So we are calculating cash inflows. So the first one is the terminal cash flow, which is the salvage value, as you are calling it, or scrap value, as you are calling it. But in technical terms, that is the terminal cash flow. Because in another question, this terminal cash flow may be used. You'll be told that the terminal cash flow is 900,000 shillings. Okay? So this is equal to 900,000. The next sentence reads that the company estimates that it will cost 2.1 million shillings per year to operate the new machine. It will cost 2.1 million shillings to operate the machine. The current manual production cost is 5.250 per annum. The current. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. Okay? Will allow the company to increase production capacity by 120,000 shillings per annum. The company realizes a contribution margin of 45 shillings per annum. That is where we also have cash flows. Contribution is a cash inflow. Okay? Is a cash inflow. So, candidates, one cash inflow is the 900,000. Then the second paragraph gives us other inflows. Other inflows. The question reads that the current manual production method costs 5,250,000 per annum. In addition to reducing annual operating costs, underline that one. In addition to reducing the annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. So, in addition to reducing annual operating costs. Now, that reduction in annual operating costs is an inflow. It is a saving. By acquiring this machine, the company is going to save. Okay, that saving is part of what we will need or use to calculate the what Omiti says annual operating cash flow, because it is annual operating cash flow. Okay, I want you to note that cash inflows can be in form of savings. It can be in form of, look at the next part of the sentence, the new machine. In addition to that, then the new machine will allow the company to increase production capacity by 120. So those are two inflows. The saving and the 120 units, because the 120 units is additional, will increase by over and above what the old machine is capable of producing. This new machine will produce excess by 120,000 units per annum. And you are given the company, that the company realizes a contribution margin of 45. Because that is the, if you understand that candidate, then we can move. We can move. So we have the terminal cash flow. Then we have the saving. Then we have the contribution. This will give us the present value of cash flows. So it's important to get the understanding. Analyze the question. Put down the formula first, then check from the question, where do you get these inputs? So you've seen this will come from, first of all, the terminal cash flow. And by the way, terminal cash flow represents the net cash flow a project or investment is expected to generate at the end of its useful life. That's what we are referring to as terminal cash flow. What is expected to be raised from the project at the end. This is a machine that is bought now, then at the end of the 6 years, it will be sold. That salvage value, or what you are calling scrap value, is a terminal cash flow. So have you understood up to that point? Because it's important for you to first of all understand where are the cash flows coming from. Because the question ends at realizes a contribution margin of 45. That is all. We've finished analyzing the present value of, the cash flows. Can we proceed? So we can proceed to calculate the cash flows. The cash flows. Let me use the term that Omiti used, annual operating cash flow. The annual operating cash flow. Let's proceed. Let's proceed. Let's put ink to paper. Ink to paper. Workings. So we are first of all going to calculate the incremental net cash flows. Omitted said operating cash flows, but it's supposed to be incremental net cash flows, which will be equal to the incremental earnings before depreciation and tax, okay, times 1 minus t plus the incremental depreciation tax shield. Underline incremental. Okay? Incremental. Why incremental? Let's take it again, the question. The company estimates that it will cost 2.1 million per year to operate the new machine. Okay? The current manual production method costs 5.250 per annum. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120 units per annum. Will allow the company to increase, okay, production capacity by 120 million. That is incremental. That there will be incremental cash flows. There will be incremental cash flows. I want you to note that the new machine will allow the company to increase production capacity by 120. Okay? So, we've seen that the cost of, let me put it down, the cost, we have the cost, the current cost, the current manual production cost method, okay? The current manual production cost, the current, let me use the words in the question, the current manual production cost is 5250. That is the current. Okay. Then we read that the company estimate that it will cost 2.1. It will cost 2.1 per annum to operate the new machine. So it's going to the new machine to operate the new machine. It will cost 2.1 million. So what is the difference? This difference is an annual saving. You understand? Currently, before, it is 5.2. But if this company buys this new machine, it will go down. This cost will go down. So what is the difference? What is the difference? Vincent says 3150. 3150. That is the annual cost saving. 3150. 3150. Correct. 3150. Now to this 3150, we are going to increase that to include that additional contribution. Additional contribution. Additional contribution, we've seen, will be 120 units. This is 120,000 units times the 45 shillings per unit. This is the contribution. We add it to that annual saving. 120,000 units times 45 shillings. How much? 5,400. 5,400. These are inflows. What is the total? Total. What will be the total? 8550. 8550. That 8550 is the annual benefit before tax. Annual benefit before tax, that one. That is the annual benefit before tax. Then what is the tax? Is it 30% of 85.50? That is the tax. Apply the tax. How much is the tax? The tax 25.65. 25.65 is the tax. Remove the tax. That will be the benefit after tax. How much is it? 59 annual after tax benefit. 59.85. This is the annual after tax benefit. That is the annual after tax benefit. Is that clear? So this is the annual after tax benefit. So I would like to understand this working among the three components of cash flows. Which working? The three components. We are calculating cash inflows. Abraham, we are calculating cash inflows. And we have seen that cash inflows are in two categories. One is the saving. This saving. If this new machine is bought, the cost of production will reduce by 3,150,000 annually. Okay. Another cash inflow is the contribution. This contribution. Because this is a new machine, this machine will produce 120,000 units more than what is being produced by the old machine. So the contribution is 45 shillings per unit. You multiply by the number of units to get this 5.4 million. Then the total annual benefit, which is equal to the saving in production costs and additional contribution. Because most questions candidates, you are always given just the contribution or the cash flows. But you need to understand this cash inflow can be in form of saving. It can be in form of saving. It's like these videos you bought, those of you bought videos at 4,500 shillings. If you are to go to a physical class, you would pay 10,000 shillings. So the difference is the saving. Okay, so it's like you've not spent the money, but you've saved. That saving, by making the decision to buy online videos, you saved money. Instead of paying 10, you are now paying 4. So the difference is a saving. So savings, when you are making the right decisions, you retain the money. So that is the money that you will retain. So that is it's like an inflow. Okay, so that is the total. Then we deduct the taxation. Then we have the annual after tax benefit. We remove the tax. And that is just one point. There is another technicality, candidates. This is not what we'll apply here. This is just a working because let me take you back to the first paragraph. The firm will incur that. Then the third sentence says the machine will have an economic life of 6 years, but it will incur an overhaul cost at the end of the 4th year. The overhaul will cost it will cost 1,125,000. After 6 years, then it will be disposed of. Okay, it will be disposed of. So Look at the board. Look at the board. The incremental cash flows, we've seen that is equal to the incremental annual tax benefit, because this is the incremental annual tax benefit, this one here, after removing the tax. This is what we have obtained. So to calculate the incremental net cash flows, which we need to discount here, we need the incremental after tax benefit, which we have calculated, but we also need the incremental depreciation tax shield. The depreciation tax shield, okay? The depreciation tax shield. We need to add to this annual after tax benefit. We need to add, this is addition, we need to add the incremental depreciation tax shield. So this is just part of the working. We need to do the incremental depreciation tax shield. And you can see depreciation is in two parts. Depreciation in this question is in two parts. So to calculate the incremental depreciation tax shield, we need first of all to determine the depreciation. It is depreciation tax shield. And the candidates, to help you understand, depreciation tax shield is the tax savings that a company realizes from claiming depreciation as an expense on its tax return. Because by now you know that depreciation is a non-cash expense that represents the gradual reduction in the value of tangible assets. So when a company purchases a depreciable asset, it spreads the cost of the asset over its useful life as a depreciation expense, as we have seen in this question. We've been given the depreciation details on depreciation. So a company will spread the depreciation expense over its useful life. And the depreciation candidate's expense effectively reduces the company's tax. All right? Depreciation reduces the company's tax. Depreciation effectively reduces the company's tax liability by an amount equal to the depreciation expense multiplied by the tax rate. So depreciation tax shield is equal to the depreciation expense times the tax rate of 30%. So to calculate the depreciation tax shield, because we know the tax rate, we are required first of all to calculate the depreciation. Do you understand? That's the meaning of depreciation tax shield. And I know you are taxation students. You've covered taxation. Understand when I say that depreciation is a non-cash expense. Okay? It is a non-cash expense. Non-cash expense. So let's calculate depreciation, which we'll now use to determine the depreciation tax shield, which is a tax saving. Okay? Depreciation. I'm aware at this point I lose some of you, but to find way you have to get lost. Okay? Then you find your way. So you want to determine the depreciation. Question reads, the company is considering purchasing a new machine so as to improve its production process, which is currently being undertaken manually. The machine costs 13. This new machine will cost 13. 13,950,000. The farm will incur installation cost of 450. The new machine will have an economic life of 6 years, all right, but will require an overhaul at the end of the 4th year. The overhaul will cost 1.125 million, okay, after 6 years, all right, after 6 years. So what is the depreciation? Annual depreciation. Now, if you are given the economic life, you are told that the machine, the farm will incur installation, and then the machine will have an economic life of 6 years. So that means that this company is using the straight line method of calculating depreciation, which is equal to cost minus salvage value over economic life. That is a straight line method. Straight line method. Okay. So the machine will cost 13,950,000. The farm will incur installation costs. So the cost will be the purchase price plus the installation cost. So that will be 13,950,000 plus 450. That is the cost, okay, that we are going to depreciate. How much is it? 14.4. So this is 14.4 million minus the 900,000. We divide by 6. We divide by 6. That is the annual depreciation. This is 2250. Then look at the second last sentence of the first paragraph. We read that the machine will have an economic life of 6 years, but will require an overhaul at the end of the first year. The overhaul will cost 1.125 million. So candidates, that cost ought to be depreciated also. You understand? If you are doing financial reporting, what does that mean? This amount has to be capitalized, just the same way we capitalized the 450. The installation cost is a cost that was capitalized. Okay? This overhaul cost should also be capitalized. The overhaul cost has to be capitalized the same way we have capitalized the installation cost. And that is what we refer to as amortization. That cost, amortization. We need to amortize. Okay? So the amortization will be from which year to each year. We read that the machine will have an economic life of 6 years, but will require an overhaul or at the end of the 4th year. at the end of the 4th year, that means that the machine will be capitalized at the beginning of the 5th year, then the 6th year. So amortization cost is going to be 1,125,000 divided by 2. That will be the amortization cost per year. How much is it? How much is it? Yes, 2 years. So per year we divide by 2. Per year we divide by 2. 562.5. 562,500 per annum. Do you understand? The cost is first of all capitalized, then you depreciate it. Do you understand? Someone is asking, why not 4? There are 6 years. 1, 2, 3, 4, 5, 6. Someone is asking, why not 4? It's not 4 because the machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. At the end of the 4th year is the beginning of the 5th year. So there are 2 years. This amortization will only apply for the 2 years. This cost will be incurred at the end of the 4th year. So that's why we are dividing by 2. 1, 2, 2 years. That is I'm answering DML's question. We are dividing by 2 because this cost was incurred at the end of the 4th year. This machine's economic life is 6 years. It worked very well in year 1. It worked very well in year 2. It works very well in year 3. It works very well in year 4 until the end of year 4. So they needed to boost this machine so that to overhaul it. Maybe there is a gadget that needed to be replaced. When you are running a machine, if you have a car, you know what I'm talking about. If you buy a new car today, you may not incur any expenses for 1 year, 2 years. Some cars is even 5 years without changing anything. But as the car is being used, the car depreciates some spares, or some, not spares, but some items, the shocks wear out, so they may need to be replaced. You overhaul it, okay? The wheels may need to be changed. So if you have a machine, that's what happened. And as I said, when you are looking at these questions, candidates have a practical mind, because this is a practical thing. Here we are talking about is practical application of is practical financial management techniques. The NPV is a practical technique. So here this machine has, when it was bought, it functioned very well year 1. Year 2 it functioned, it's meant to function very well. Year 3 to function very well. In year 4, this machine is getting tired. And the same thing even happens to you. When you are young, you run. As years go by, you find that the speed reduces. As you age, sometimes you are not able to walk. All right? There are people who bend even their back. There comes a time you cannot walk. Machines also, they have economic life. You see, the life as the machine is being used. So at the end of the 4th year, the machine was, the company had to spend 1,125,000 to overhaul it. That means that the machine was in business just for 2 years, because at the end of year 4, it's the beginning of year 5. So it was depreciated in the 5th year and the 6th year, 2 years. You understand? And the same way we added 450, the installation cost, it was capitalized. Okay? And there is even a standard. If you are a financial reporting student, you should be able to tell me under which standard do we capitalize such costs. Okay? If you are an auditing student, as an auditor, you are also required to know that standard, so that when you are auditing the records of a company that has made such an expenditure, you need to check if this expenditure was capitalized. Okay? If it was capitalized. So I've answered the question on 2 years. Can I have another question? So that is, where were we? We are here. We are here. So why are we calculating depreciation? Why are we calculating depreciation? Let's get back. We digressed a bit. Why are we calculating depreciation? We are calculating depreciation so that we can apply the tax rate to get the incremental tax shield, which will now help us to add to the annual after-tax benefit to give us the incremental net cash flows, which will now get the present value, then deduct the initial investment to get the NPV, then we can advise the company. Because after understanding the depreciation part, this is part of a working. We've calculated the incremental after-tax benefit. We need to add the incremental depreciation tax shield, okay, which is a tax saving. Okay, we say that depreciation tax shield is a tax saving that a company realizes from claiming depreciation as an expense on its tax return. Is that clear? Is that clear? Someone said that that one is tricky, which now is not tricky. Can we now proceed? So we need to calculate the depreciation tax shield. Depreciation tax shield. Depreciation tax shield. So from year 1 to year 4, depreciation tax shield will be different. From year 5 to year 6 per year. Okay? Depreciation tax shield year 1 to year 4 will be the tax, because DTS, the tax saving, is equal to the tax rate times the depreciation, 2250. That is per year. Then year 5 to year 6, the depreciation is, tax shield will be 30% times 562,500. So can you give me the depreciation tax shield from year 1 to year 2? And this should be per annum. 2,250,000 per annum. What will be the DTS per annum? The DTS per annum. So we have depreciation tax shield year 1 to year 4. Then we have year 5 to year 6. Please pay attention. Pay attention. Or let me analyze. Let me find a way of simplifying it. Let me find a way of simplifying depreciation before the tax shield. This is still okay, but let me present this differently so that someone does not say depreciation is also, the depreciation tax shield is also tricky. So that you may not say it is tricky, let us analyze depreciation. Let us analyze depreciation before we get to the tax shield. So we have depreciation year 1 to year 4. Then we have depreciation, this amortization, year 5 to year 6. Depreciation is in two categories. Depreciation from year 1 to year 4. Okay, that is depreciation per annum. Per annum from year 1 to year 4 is 2250. Okay, per annum. This is depreciation per annum. The other category is year 5 to year 6. We still have 2250. All right. Then we have annual amortization. Annual amortization. There is no amortization between year 1 and year 4, but we have this amortization per annum of 562,500. So this will be the total. You have that total and we have that total. So this is 2250. Then give me this total. 2250 plus 562,500. 2812. 2812. 28 2812. 2812. Abraham says 2418. 2812,500. 2812,500. So this was yet another complication. Candidates, the depreciation per annum from year 1 to year 4, we calculated it here. This is the depreciation per annum. Year 1 to year 4 per annum, 2,250,000. Depreciation per annum for the 2 years is in two parts. This original machine, which has a salvage value at the end of 6 years, so this one is maintained at that. Then we add this amortized cost, the amortized cost. Okay, the cost that we amortize, 562,500. Overhaul cost is also capitalized and depreciated or amortized. It is amortized. So between year 5 and year 6, these 2 years, the annual depreciation is not 2,250,000, but 2,250,000 plus 562,500. Is that clear? Is that clear? So that the depreciation tax shield per annum, year 1 to year 4, will be 30 percent times 2250, and for the other 2 years, this is per annum. What we get here is per annum. For the 2 years, it will be 30% times 2812.5, again per annum. That is the DTS per annum. DTS per annum. How much? Yes, it is clear. Abraham says year 5 to 6, 873. The depreciation tax shield year 1 to 4. This is 843. 843. 843. 843. Okay. How about year 1 to year 4? 843, 750. Per annum, year 1 to year 4. Year 1 to year 4. 675. 675. So this is 675. That is the depreciation tax shield. Why are we calculating the depreciation tax shield? So that we can add it to the incremental annual after tax benefit to get the incremental net cash flows. All right. So is that clear up to that point? So we need to add these two. Incremental cash flows. Incremental cash flows. So we have year 1 to year 4. Year 1 to year 4. The annual after tax benefit. Annual. This one. After tax benefit. From year 1 to year 4 is 59,85,000. The same here, 59,85,000. Okay, that is the annual per annum. Per annum. Then we add the DTS, incremental DTS. We add this annual incremental DTS, which you've calculated here. From year 1 to year 4 is this one, 675. We are adding candidates, this and that, to get the incremental net cash flows. So year 5 to year 6, the DTS is 843,750. So we're going to add these two. That will give us the incremental net cash flows. The incremental net cash flows. The incremental net cash flows. So the total, give me this total. The incremental net cash flows, year 1 to year 4. Incremental net cash flows, year 1 to year 4. Israel says 1,666. 666. Is it 666? 666. 66600. Yeah, 66000. Year 5 to year 6. What is the total incremental cash flow? 620, 68 28, 68, 28, 68, 20, 68, 28, 750, 750. These are very important working. That is a very important working. So at this point, I need another paper. In an exam, you call for another booklet. Okay, if you're in an exam, see you have done everything. So you ask for another booklet so that you can continue. I don't need this. Yes, I don't need this. I don't need this. I don't need this. Another booklet. All these workings, candidates, was to help us get the cash flows. These are cash flows. These are the cash flows. And these cash flows are future values, which we now have to discount. We're now going to discount these values so that we get the present value, the summation of the present value of the cash inflows. And remember, we've not even done that again. After that, we'll calculate the initial. So do you understand how we are moving? We are now want to discount these cash flows, because you see these are values at the end of year 1, at the end of year 2, year 3. These are in future terms. So we need to discount, then we deduct the initial investment to get the NPV, then we will advise this company. Are we on the same page? We need to get the present values. Present values. We are now going to get the present values of the cash inflows. So begin with the year. We'll have a column for year. And you see we have year 1 to year 4 cash flows. Year 1 to year 4 cash flows. So we have year 1 to year 4 cash flows. Then we have year 5 to year 6 cash flows. Do you see the cash flows? Year 1 to year 4 cash flows. Year 5 to year 6 cash flows. They are different. The cash flows that will be received from year 1 to year 4 is different from the cash flow that will be received from year 5 to year 6. So we have to make it clear. Then we recall the terminal. There is also the terminal cash flow. The terminal cash flow, the 900,000. We also need to discount it. So these are cash flows. Year 1 to year 4, 666, 666. Year 5 to year 6, that is 6828, 6828, 750. Terminal cash flows, 900,000. Then we are going to have the present value annuity factor. Now, these cash flows are also in 2 categories. These are annuities, because they are uniform throughout year 1 to year 4. It's the same. That's an annuity, an inflow. Every year from year 1 to year 4, the company will receive 6,650,000. It is an annuity. So we are going to discount this one. Let me have it here to help you understand. This first one is going to be the present value annuity factor. We know the discounting rate is 20% from the question. The last additional information FILA Limited requires 20% return on all investment. So the discounting rate is 20%. 4 years. So you're going to multiply this one, the present value annuity factor, 20%, 4 years. What is the factor? Give me the factor. 2.5887. 2.5887. The other one is 6 years. Only change this to 6. Give me the factor. To get the present value annuity factor at this point, year 5 to year 6, the factor will be present value annuity factor 20%, 6 years, minus present value annuity factor 20%, 4 years. So you are going to calculate two factors. The difference is what we are going to have here. So if you got 3.3255, so it's going to be 3.3255 minus 22, 2.587. That would be equal to 0 point something. 0.73, 0.7368. 0.7368. I know we'll lose a few people there, those who did not attend our classes. You will have a question here. Why not 3.3255? You'll have questions. Let's move on. The factor for the terminal cash flow. Give me the one for 900. This one. Someone says 0.7368. If you got that one, this is wrong. If this is what you are getting, then that is not correct. Ask me why. This one is not correct. Yes, 0.3349. You saw your mistake. 0.3349. 0.3349. 0.3349. 0.3349. Then apply the factor to the cash flows. Give me the present values. Then give me that total. Present value 1 to year 4. Multiply that by that right there. That by that right here. Right by that right here. Get me the total. How did you get 0.3349? How did you get 0.3349? How did Emma get 0.3349? 0.3349, Emma, is not an annuity. It is not an annuity. It is a lump sum. This money will be received at the end of the economic life. It is a terminal cash flow. It is a terminal cash flow. And we say the terminal cash flow is the amount of money that the company expects to receive at the end of the life of the asset. So it is a lump sum. It is not an annuity. And the present value interest factors of annuities, the formula is different. This is the formula 1/1 plus R raised to N. That is how you get 0.3349. Where R is 20%, N is 6 years. Is that clear, Emma? Correct. Total 22,573. Someone is getting 22,573. 22,573. 575. 575. Third is 30, 14, 10. 30, 14, 10. Second 50, 31. 50, 31. 50, 31. 423. 423. The first one 17, 240. 17, 240. 17, 247. 742. That's the total. Make sure you get the figures right. Make sure you get the figures right. That is the figures right. Okay. So that is the total present value of cash flows. This is the total present value of cash inflows. All right. Then we deduct the initial cash outlay. Initial cash outlay. Initial cost. Initial investment. What is the initial investment? Look at the question. The machine costs 13,950. That is the purchase price is 13,950. We add the installation cost of 450. What is the total? Purchase price plus installation cost. Purchase price plus installation cost. 14,400. 14,400. To this 14,400, we add the present value of overhaul cost. We have to add the present value of the overhaul cost, which we saw will happen at the end of the 4th year. We are calculating the initial investment, which you have seen is equal to the cost of the machine plus installation cost plus the present value of overhaul. Present value of overhaul cost. The overall cost is 1125. So the present value will be 1125 times 1 over 1 plus R. Our R is 20%. It will be 1.2 raised to 4. So what is the present value? Kenneth says 542, 587. 542, 542, 587.5. 587.5. So what is the total? Purchase price plus installation cost plus the present value of overhaul cost will give us the initial investment. Again, it says 14,942. 14,942. 14,942. 14,942. 587. 14,982. 587. 587.5. Give me the net. What is the net present value? Mary says 76. Money 7630. 7630. 7630. 7630. 7630. 987. 987.5. That is a positive NPV. That is a positive NPV. Is everyone getting the same answer? 76. Israel is getting 7630. Yeah, 7630. 7630. So what is the advice? Because you are to advise using the NPV project evaluation method, advise filler on whether or not to purchase the machine. Purchase or not purchase? Advice. Purchase the machine because the NPV is positive. Purchase the machine because the NPV is positive. NPV is positive. Formula. Advice. Okay. How many marks? 12 marks. So the reason why we've taken too long is because I'm taking time to help you understand. I'm also explaining terms, defining this. The terms that Abraham is talking about, I have defined all of them in this lesson. Is highlighted the incremental DTAs, the DTAs, the earnings before depreciation and tax, the terminal cash flows, all these factors I have explained. And it looks complex because you are doing it for the first time. Don't expect to just understand the question once and for all. No, you cannot just understand, or you cannot afford to just give up because it looks complex. You will recall there was a time you are not able to add 2 to 1. If you have a kid, just ask your kid 2 plus 1. The kid, today I asked one who was coming from school, another kid, I asked the kid, what is 1 plus 0? She told me 0, all right? There was a time you are also not able to answer such. So the reason why this one looks complicated is because you are doing it for the first time. And in the event that you get to the exam in the state you are in today, this is a question you avoid doing fast. You know, it's appearing as number 2. So this one, you need to run away from it. Do it as a last question. If you find it complicated, then you attempt, say, question 4, if you think it is easy. If you think there is any one that is easier, then you can attempt the ones that are easy so that you get time to come and it's true the question was not direct, because even the initial investment was not provided directly. It had some level of complication, and you've seen it here, because this one would earn you, say, half a mark. Do you understand? This can earn you half a mark, but it is also not direct. There was a working for it. Initial investment, purchase price plus installation cost plus the present value of overhaul cost. So the question was true indeed, not direct, but I've also helped you to how to approach such a question. First, put down the formula, then work downwards. Check from this formula what items can you, because you may not get this answer correct, but there are still, if you have correct workings, you can earn some marks. Okay, if you have done the correct amortization, there is half a mark for that. If you've done the depreciation, you get a mark for all that. So candidates, that is the end of the lesson. In this lesson, we've answered question 2, August 2023. In our next session, we are going to answer question 3, financial management, August 2023. Bye-bye. Hello and welcome candidates to the lesson. The subject is boardroom dynamics. Today I'm going to start the revision of the paper that was done on Tuesday, 25th April 2023. Boardroom dynamics. Time allowed 3 hours. Instructions are as follows. Answer all questions. Marks allocated to each question are shown at the end of the question. Do not write anything on this paper. Do not write anything on the paper. So we're going to take a question at a time. This paper has 5 compulsory questions. The first question is a case study, and in April 2023 sitting, the case study about the Loden Cranes Incorporation. I'll first read the case, then we answer the questions below it, that is A, B, C, and D. First paragraph reads as follows. Loden Cranes Incorporation was founded in a small town in Kenya 20 years ago by a group of 10 engineers. The company specializes in the manufacture of various plastic items, including furniture and packaging containers. The 10 founders of the company became the directors of the company and held all the top leadership positions. After 3 years of operation, they decided to broaden diversity in readiness for listing at the Securities Exchange. Independent directors needed to be added to the pool of directors. The achievement of board dynamics was greatly informed by psychological theories. Paragraph 2. The company was eventually listed at the Securities Exchange in November 2020. The founders were fully aware that the listing would allow them to fund and help sustain LKI's growth potential. The company has been growing its portfolio of products steadily, and currently it has over 100 lines of production domiciled in over 2 outlets spread across the country. Market capitalization of the company at the end of December 2022 was 517 million Kenya shillings. In the recent past, the company has been struggling in upholding good governance principles. The company has been facing integrity challenges. It has fallen back in terms of compliance with various statutory requirements. The company operates in a laissez-faire mode where each department is more or less autonomous. Each employee is aware of the fact that there is no documented decision-making tool, a fact that brings about confusion, thereby affecting overall productivity. Meetings in the organization have been very informal. Despite the informal nature of meetings, many directors are highly skilled and dispense their business effectively. During their last meeting, the directors resolved to schedule capacity building sessions so that they could be trained on good corporate governance and board programs. Required: A. Advise the management of the company on the tools that they may adopt to facilitate effective decision making in the corporation. 10 marks. B. Examine 5 governance theories that could inform the company's board structure. 10 marks. C. Analyze 5 skills that could enable the Directors become more effective in handling their tasks, 10 marks. And lastly, discuss the essential attributes of the directors that were added to the pool at the company in order to achieve board diversity. We'll first answer part A, advise the management of Lord Crane's Incorporation on the tools that they may adopt to facilitate effective decision making in the corporation. Tools to do what? To facilitate effective decision making. Tools to do what? To facilitate decision making. That is part A of this question, the case study. The question is asking candidates to do what? To identify tools to facilitate. Tools to facilitate effective decision making. Advise the management of the company on the tools that they may adopt to facilitate effective decision making in the corporation. In paragraph, the first paragraph, that is the third paragraph we read, that in the recent past, the company has been struggling in upholding good corporate governance. The company has been facing integrity challenges. It has also fallen back in terms of compliance with various statutory requirements. The company operates in a laissez-faire mode, all right, where each department is more or less autonomous. Every employee we read is aware of the fact that there is no documented decision-making tool. Do you see that? Every employee is aware of the fact. It is a fact that there is no documented decision-making tool. And due to that fact, there is a lot of confusion. The question is a factor that brings about confusion, thereby affecting overall productivity. So there is no documented decision-making tool. So the candidates are required to advise the management on the tools that they may adopt. The first one could be what we call decision-making frameworks. The company could adopt decision-making frameworks. Decision-making frameworks. What are these decision-making frameworks? Now, candidates implementing structured decision-making frameworks can provide a systematic way or approach to resolving issues and making choices. And there are many decision-making approaches which we covered in our class. Remember, we discussed about the rational decision-making model. A good example is the rational decision-making model. That is one example of a decision-making framework. Rational decision-making model. There are many more, like the incremental decision-making model. Incremental decision-making model. The incremental decision-making model. We have the bounded rationality model. Bounded rationality model. The bounded rationality model is another example of a decision-making framework. The bounded rationality model. The incremental decision-making model. The rational decision-making model, and many more models. So by using such frameworks, the directors can evaluate options, they can consider potential risks, they can arrive at well-informed decisions, and so on. So these are some of the tools that we can discuss under point number 1. Then under point number 2 is what we call SWOT analysis model. The SWOT analysis model, where S stands for strength, W stands for weaknesses, O stands for opportunities, and T stands for threats. All right? This is a model that can assist or help the company assess its internal as well as external factors. The model aids in identifying areas that require improvement, that require understanding marketing trends, and making strategic decisions, providing directors with such information as far as the strength, the weaknesses, the opportunities, and threats of the company is concerned. SWOT analysis is yet another tool that can facilitate effective decision making. 3, decision support system. Decision support system, the DSS. DSS. The company can introduce the DSS software that can provide directors with analytical tools and real-time data for making informed decisions. The DSS candidates can help or assist in forecasting. The DSS can also help in scenario planning. It can help in risk analysis, thereby enhancing the quality of decisions. The DSS software. 4, governance policies. The company can put in place governance policies as well as procedures. Governance policies and procedures. Establishing clear and documented governance policies and procedures can create a framework for decision making. It also ensures transparency, it ensures consistency, it ensures accountability throughout the organization. Coming up with governance policies and procedures. 5, risk management framework. Another tool is developing a risk management framework. Implementing a risk management framework can enable the identification, can enable the assessment, and also the mitigation of potential risks. And that helps the directors make decisions while considering potential consequences and safeguards that the company may face. Risk management framework. Establishing a risk management framework is another tool to facilitate effective decision making. 6, task force and committees. Task force and committees. Setting up task force or committees to address specific issues can provide focused attention, can provide focused expertise for complex decisions. And such teams or committees can thoroughly analyze matters and propose recommendations. to the board for consideration. That's one tool to facilitate effective decision making. The company may be faced with complex problems, complex situations. When that happens, then establish a task force. Set up a committee to look into the complex matter. Set up a committee to thoroughly analyze matters and propose recommendations to the board for decision making. Six or seven regular board meetings is another tool. Regular board meetings, formalizing board meetings with a structured agenda, with the minutes, ensures that all key topics are discussed, decisions are recorded, progress is monitored, and so on. Regular board meetings. These are additional points. Candidates were to give just 5 tools. I've given you 7. There are many more tools like expert consultations, seeking expert opinions and advice on critical matters can provide valuable insights and help in making well-informed decisions by the board. So these are tools to facilitate effective decision making. Number 1 is establishing decision making frameworks. Under frameworks, I gave examples like the rational decision making model, the incremental decision making model, the bounded rationality model. The second tool is SWOT analysis. The third tool, decision making support system. The fourth tool, governance, policies and procedures, establishing governance procedures and policies. Number 5, risk management framework, putting in place a risk management framework, establishing a task force or committees to handle complex matters. I've also identified another tool which I call regular board meetings. Then lastly is the expert consultations. Let me put it down. Expert consultations. Expert consultations. Expert consultations. Any 5 points here could earn you the 10 marks. 10 marks. Any 5 points. Any 5 points. Even in point number 1, if a candidate was to explain the rational decision making model, would earn a mark. Incremental decision making model, that would earn you a mark. The bounded rationality model, these are tools that facilitate decision making. I'm now going to part B. Examine 5 governance theories that could inform the company's board structure. Governance theories. Examine 5 governance theories. 5 governance theories. Examine 5 governance theories. Governance. This was yet another easy part of this question. The first governance theory we know is agency theory. Agency theory. Now, this theory examines the relationship between the principals, who in this context are the shareholders, and the agents, who are the directors or managers. This theory emphasizes the interests of agents with those of the shareholders. It emphasizes aligning the interests of the shareholders with those of the agents. Why? In order to minimize any conflicts, ensure effective decision making in the company. Agency theory. I've said the theory examines the relationship between the principal, the principals, these are shareholders, and the agents, these are the directors or the managers. The theory seeks to align the interests of the principals and the interests of the agents so that there is minimal conflict between the principals' interests and the interests of the agents. That is the first governance theory. The second governance theory is stewardship theory. Now, in contrast to the agency theory, the stewardship theory views directors and managers as stewards who act in the best interest of the company. And according to this theory, directors are more likely to make decisions that promote the long-term organizational success and sustainability growth. Stewardship theory. Number 3 is stakeholders theory. Stakeholders theory. Stakeholder theory. Now, this theory, the stakeholders theory, emphasizes considering the interests of all stakeholders. Stakeholders are people or persons who have an interest in the company, people who have a stake in the company. And this could be the suppliers, the employers, the shareholders, the employees, the customers, the government, any person who is affected by the actions of a company is a stakeholder. The stakeholder theory, therefore, emphasizes the need to take into consideration the interests of all the persons who have an interest in the company, and not just the shareholders. Here, the interests of all the other stakeholders other than the shareholders should be emphasized. And adhering to this stakeholder theory can lead to more socially responsible decisions by the company. Adhering to stakeholder theory also improves the reputation of the organization. Stakeholder theory means or emphasizes the need to take into consideration the interests of all the persons who have a stake in the company. I've mentioned examples of stakeholders: the government, the employees, the suppliers, the customers, and so on. Resource dependency theory number 4. Resource dependency theory. Resource dependency theory is a fourth governance theory. Resource dependency theory suggests that organizations are influenced by external resources such as capital and expertise. And this company can use the Lord&Krinces company can use this theory to do what? To gain access or to diversify its network and build relationships with various stakeholders to gain access to essential resources. Do you understand? The resource, from the word resource dependency theory, resource dependency theory. Resource dependency theory emphasizes or suggests that organizations are influenced by external factors, by external resources such as capital, expertise, and so on. Resource dependency theory. Number 5, contingency theory. Contingency theory. Contingency theory suggests that there is no one-size-fits-all approach to governance. There is no one-size-fits-all approach to governance. And the most effective governance structure depends on the specific circumstances of the organization. There is no one approach that fits all or that can be applied in all the situations. You understand? Contingency theory. There is no one size fits all approach to governance. And that the most effective governance structure depends on what? On specific circumstances of the organization. And therefore, this company, for example, the Lord's Crinces Incorporation, can tailor its governance practices to suit the company's unique characteristics and challenges, because this company is unique, and therefore the company should develop or come up with an approach that is unique to its challenges, that can address governance problems. So these are 5 governance theories that could inform LKIS board structure. 1, agency theory. 2, stewardship theory. 3, stakeholders theory. 4, resource dependency theory. Then 5, contingency theory. C, analyze 5 skills that could enable LKI directors become more effective in handling their tasks. Skills. The question is testing candidates' knowledge on skills that could enable directors become more effective. Skills that could enable directors become more effective. Skills that could enable directors become more effective. One important such skill is developing what we call strategic vision. Strategic vision. Strategic vision. Directors need to have a clear strategic vision for the company's future, and then align their decisions with the long-term goals. And that involves understanding market trends, that involves understanding competition, that involves understanding potential opportunities. A skill to understand the market trends, you require to have a skill to understand the potential opportunities and so on. So directors should have strategic vision, the long-term vision. They should have clear strategic vision for the company's future. That will enable them to become more effective. Financial acumen. Financial acumen is another skill. The director should have strong financial literacy. A strong financial literacy. Candidates, is essential for directors to analyze financial statements, to analyze budgets and investment decisions effectively. Directors may be called upon to make decisions related to investment. Directors may be called upon by the very nature of their job to analyze financial statements that are prepared by the accountants of the company. And to analyze financial statements, one needs to have financial acumen. One needs to have literacy, a strong financial literacy. And that's a very important skill that could enable directors become more effective. Communication and interpersonal skills, number 3. Communication is a skill that directors need to possess. Effective directors should be able to communicate their ideas. They should be able to communicate their concerns. They should be able to communicate their decisions clearly to the entire organization. We mentioned here, directors should have a strategic vision. This vision that the directors should have about the organization ought to also be communicated to the other members of the company, to other stakeholders. And therefore, the directors should have communication skills. They should be able to communicate clearly. They must foster a healthy relationship with the shareholders, with the management, and other stakeholders. And that can only happen if they have communication skills. They should be able to communicate their ideas, their concerns, their decisions clearly to the entire organization, to the stakeholders, and so on. Communication and interpersonal skills. Problem-solving skills, or what we call analytical skills, is another skill that could enable directors become more effective. Number 4, analytical skills. Problem solving. Problem solving or analytical skills. Problem solving skills or analytical skills. Problem solving. Directors should be skilled in analyzing complex situations, analyzing complex issues. The directors should have skills in identifying challenges. The directors must have skills in proposing effective solutions to the challenges that they have identified. So it's not enough to just identify challenges. It's also important the directors also have skills to propose effective solutions to the challenges that are faced by the organization. 5, ethical decision making. Ethical decision making, from the word ethics. The director should be able to uphold ethical standards. Why? Because upholding ethical standards is essential for directors, especially in addressing integrity challenges faced by the company. So ethical decision making ensures that the company operates with integrity and also maintains a positive reputation. because we all know by now that a positive reputation is an asset to any organization, is an asset to any person. One who holds ethical or one who is has high standards of integrity. A company that upholds ethical standards is a company that is likely to maintain a positive reputation, and is a skill that directors must learn: ethical decision making. So these are 5 skills that could enable the directors of this company become more effective. Strategic vision, number 1. Number 2, financial acumen. Number 3, communication and interpersonal skills. Number 4, problem solving or analytical abilities. Then number 5, ethical decision making. Ethical decision making. So that is part C of that question. Part D, discuss the essential attributes of the directors that were added to the pool at LKI in order to achieve board diversity. All right. We read in the question that meetings in the organization have been very informal. During their last meeting, the directors resolved to schedule capacity building sessions so that they could be trained on governance, good corporate governance, and board programs. So the question here is, discuss the essential attributes of the directors. D. Essential attributes of directors that were added. So there are directors that were added to this board because we read that the 10 founders of the company became the directors of the company and held all the top leadership positions. After 3 years of operation, they decided to broaden board diversity in readiness for listing at the Securities Exchange. They decided to do what? To broaden the board diversity in readiness for listing at the Securities Exchange. The achievement of board directors was greatly informed by psychological theories. The question is, what are the essential attributes of the directors that were added to the pool? The first attribute is diversity in backgrounds. Diversity in background. 1, background diversity. When new directors were recruited, one important attribute to look at, or that was looked at, was the diversity in their backgrounds. The new directors should come from various professional backgrounds, from various industries and experiences, because this diversity brings different perspectives, brings different expertise to the board, and thereby promoting innovative thinking. Innovative thinking. 2, inclusive mindset. Inclusive mindset. Directors with an inclusive mindset actively seek to understand and also to appreciate diverse viewpoints. Such directors should value contributions from all board members, regardless of their backgrounds. So directors that were included should be ones that have what we call an inclusive mindset. This is a mindset that tolerates diverse opinions. Do you understand? 3, industry knowledge. Industry knowledge. Adding directors with relevant industry knowledge and expertise can help this company to navigate challenges specific to their sector and also stay competitive. 4, another essential attribute is that of independence. 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 Directors of a company should have independent mind. Independent mind. Why? Because independent directors are crucial for maintaining impartiality and avoiding conflicts of interest. They should not only have affiliations, but also financial interests or ties to the company. So when recruiting the new directors, an essential attribute that should be considered or that was considered is that of independence. The directors ought to be independent. 5, governance experience. Governance experience. Directors with prior governance experience bring valuable insights into the company. They bring into the company what we call best practices and can help the company improve its governance standards. And therefore, candidates, by embracing these diverse attributes, the company can benefit from robust discussions. The board can benefit or can make better decisions and also enhanced governance practices. So these are some of the essential attributes that were added, that were considered when adding new directors to the company. Number 1, background diversity. Number 2, inclusive mindset. Number 3, industry knowledge. Number 4, independence. Number 5, governance experience. How many marks? This should earn 10 marks. 10 marks. So these are 10 marks. Part C, 10 marks. Part B, 10 marks. Giving us a total of 40 marks. So this is the case study that was tested in April 2023. The subject is boardroom dynamics. The course is certified secretaries. Thank you for attending this lesson. In our next lesson, we're going to answer question number 2 from the same sitting. Bye-bye. Hello everyone and welcome to the lesson. The subject is boardroom dynamics for certified secretaries. We've been answering questions from the past paper that was examined in April 2023. So far we've done question 1 up to question 3. Today I'm going to answer question number 4, which part A reads, the broad substance of the Cadbury's report of 1992 emphasized that an approach based on compliance with voluntary code coupled with disclosure will prove more effective than a statutory code. With reference to the above statement, explain 4 recommendations in this report which have been adopted by public companies. With reference to the above statement, explain 4 recommendations of the Cadbury report. We are answering questions from the April 2023. This is question number 4, part A. Four recommendations. That's the question. 4 recommendations of the Cadbury report of 1992. 4 recommendations that have been adopted by public companies. The first one is in relation to the composition of the board. 1. Board composition. That is one of the recommendations that have been adopted by corporations. Board, number 1, board composition. The report recommended that boards should be composed of a balance of executive and non-executive directors, because non-executive directors bring independent oversight and diverse expertise to the board, reducing the concentration of power in the hands of the executive. The report recommended that a board should be composed of both the executive and the non-executive directors. The second recommendation is on the role of the executive directors. The role of non-executive, directors. This report emphasized the importance of non-executive directors in providing an independent judgment on issues, especially related to executive remuneration and appointment of executive directors. The role of non-executive directors is very important as far as the Cadbury report is concerned. Role of non-executive directors. Another recommendation is in relation to the audit committee. Audit committee. The audit committee. The report recommended that there should be established an audit committee comprising of non-executive directors. The audit committee should comprise what? Non-executive directors. And these committees are responsible for overseeing the financial reporting, overseeing internal controls and risk management, and thereby enhancing transparency and accountability in the company. Audit committees. That is one of the recommendations of the Cadbury report. 4. Remuneration committee. The remuneration committees. Now, the Cadbury's report recommended that boards should set up remuneration committees to determine executive pay, ensuring that it is fair, reasonable, and linked to the company's performance. And this measure, candidates, is aimed to address concerns about excessive executive compensation. So these are 4 recommendations of the Cadbury report of 1992 that has been adopted by many public companies. 1. Board composition. 2. Role of non-executive directors. 3. Audit committees. And 4. Remuneration committee. 4 recommendations. How many marks? 4 marks. 4 recommendations, 4 marks. Part B reads, examine 5 ways of ensuring effective board succession. 4 ways of ensuring effective board succession. 4 ways. 5 ways, not 4, but 5 ways. B. Five ways of ensuring effective board succession. The first obvious way is succession planning. Succession planning. We are discussing ways of ensuring effective board succession. The company should develop a structured and comprehensive succession plan that identifies potential candidates for executive and non-executive roles within the organization. And that plan should consider both the short-term and long-term talent needs. Succession planning. Talent development. Number 2, talent development. The organization should implement leadership development programs, and the purpose of these programs is to groom and nurture potential successors. Such programs should provide training, should provide mentoring, should provide exposure to different areas of the business to prepare individuals for future leadership roles. Talent development. The managers should be developed. Talent, they should be trained. So that is another way of ensuring effective board succession. Talent development. 3, board evaluation. Board evaluation is yet another way of ensuring effective board succession. Board evaluation, the board should conduct regular board evaluations to assess directors' performance and also identify areas for improvement. Such evaluation process helps identify potential gaps. These are gaps in skills, gaps in experience that needs to be addressed during succession planning. Carry out board evaluation with the view of identifying any gaps, so that if there are any gaps, they can be filled, and that can help in effective board succession. 4, external search. External search, or we can say external recruitment. Recruiting from external sources. The company should consider external candidates when seeking to fill board vacancies. Why? Because external directors can bring fresh perspectives, can bring diverse expertise to the board. They can also complement the existing skill set. So that's another way of ensuring effective board succession. Recruit from external sources. Another way is what we call board diversity. Board diversity. The company or the board should promote diversity in the boardroom, including diversity in skill, experience, background, demographics, and so on. Why? Because a diverse board can foster innovative thinking and adaptability, contributing to effective succession, board succession. So these are 5 ways of ensuring effective board succession. Number 1, succession planning. Number 2, develop talent. Number 3, board evaluation. Number 4, external recruitment. Then lastly, board diversity. These are 5 ways, 5 marks. 5 ways, 5 marks. That is part B. Then part C reads, discuss 3 types of corporate culture. Types of corporate culture. I'll answer it here. Types of corporate culture. The first type, these are types of hierarchical culture. The first type is hierarchical. Hierarchical culture. From the word hierarchy. Hierarchical culture is one of the types of corporate culture. Here, candidates, the organization has a chain of command and decision-making authority, which is concentrated at the top. And such culture values compliance with rules and procedures and communication. In such a culture, typically flows from top to bottom. And employees are expected in such a culture to follow directives from their supervisors without questioning them. Hierarchy. Information flows top down, top to bottom, top to bottom, hierarchical. In a hierarchical culture, I've said the organization has a clear chain of command, and decision-making authority is concentrated at the top. Such culture values compliance with rules and procedures, and communication flows from top to bottom. That's one type of corporate culture. Then number 2, we have innovative culture. Innovative culture. Now, an innovative culture encourages creativity. It encourages risk-taking and continuous improvement. And in this type of culture, employees are empowered to think outside the box. They are encouraged to propose new ideas and experiment with the new approaches. And here, candidates, there is a focus on adaptability and embracing change in order to stay ahead of the competition. Innovative culture, thinking outside the box. 3, customer-centric. Customer-centric culture. Customer-centric culture. Now, a customer-centric culture prioritizes the needs, prioritizes the preferences of the customers. Here, the organization emphasizes delivering exceptional customer experiences and aligns its strategies with customer satisfaction and loyalty. So, in such a culture, employees are encouraged to listen to customer feedback and make decisions that prioritize customer interests. So these are 3 types of corporate culture, and it's important to note that corporate culture can be a blend. It can be a blend of these 3 types of culture. It can be a blend of the 3 types of culture, or may vary across different departments or even divisions within the same organization. For example, you may have the marketing department developing a customer-centric culture, because the marketing department is in touch mostly with the customers. So it may vary even within the divisions of the same organization. And candidates, the culture plays a significant role in shaping the behavior, in shaping values, in shaping the organization. And also the values, culture can also shape the values, it can shape the overall performance of the company. So these are three types of corporate culture. Hierarchical culture, number one. Number two, innovative culture. Number three, customer-centric culture, customer-centered culture, customer-centric culture. These are three types of culture. Three types of culture. How many marks? 6 marks. Corporate culture, 6 marks. So that will mark the end of the revision of boardroom dynamics for certified secretaries. We've done question number 4. That was examined in April 2023, Part A, 4 marks, Part B, 5 marks, and Part C, 6 marks, giving us a total of 15 marks. In our next lesson, we are going to answer the last question, that is question number 5, which again is in 3 parts. Part A reads, describe 3 standards of good corporate governance as stipulated by the Capital Markets Authority Code or its equivalent. Number 3, determine 4 situations where avoidance would be the most suited method to manage conflict, 4 marks. Then lastly, explain 4 benefits of evidence-based decision making, 8 marks. Try to attempt question number 5 before coming into the next lesson. Thank you. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Mlingwiri and I practice within the financial services industry in Kenya. Ladies and gentlemen, today we are discussing about equity valuation models. To begin this lesson, we are going to discuss about the dividend discount model, single stage, 2-stage and multi-stage models. So this is Excel, and what I've done is that the usual cells have actually been done away with. Say for example, I've actually come here and I decided to, you can see the colors over there. So I decided if I put no fill right over here, you'll be able to see the typical Excel worksheet like that. But for simplicity's sake or even for visual presentation, I felt it would be good for us to come right there and then we put it a white background like that. So the discounted dividend model is a model that was, or what we can say the constant growth model was developed by Gordon. And under the single model, it assumes that the firm expects to pay a dividend in 1 year. So we can say, so we can write that the firm expects to pay dividends in year 1, in 1 year, in 1 year. The second assumption is that dividends grow indefinitely at a constant rate. Dividends grow indefinitely at a constant rate, indefinitely. Yes, so that is it there. And finally, the third assumption is that the growth rate is less than the required return. The growth rate is less than the required return. So those are the assumptions, and for simplicity's sake, what I can be able to do is that I can select all of them, the 3 assumptions, as I move down like that, and then I press Control bold, and then Control bold, it will unbold that. So if you press Control B, I'll bold that. Control B again, it will unbold that. So these are the assumptions of the DDM. And under the DDM, specifically the single stage DDM, it assumes that the firm expects to pay a dividends in 1 year. So this is the historical dividends, the D naught, then 1 plus G. So if I grow it by a factor of G, which is assumed to be constant, then I should be able to get the expected dividends, the future dividends, and so on and so forth. So the firm expects to pay dividends in 1 year. Dividends grow, the next assumption is that dividends grow indefinitely at a constant rate. So the growth rate is constant, and this graph depicts that constant growth rate. So you can see the 3.5% dividend is constant, or the growth rate in dividends is constant from time 0 through to time period 9, and indefinitely moving towards the right there. So this graph tries to explain this second assumption. The third assumption is that the growth rate should be less than the required return. So the R should be less than the G, like that over here. So if I can put brackets onto this part right here, that to represent constancy, this model and this one over here, the best way to try and apply this on Excel is by looking at an example. So the example on your screen reads as follows. Down Under Financial recently paid a dividend of 1.8 Australian dollars. An analyst has examined the financial statements and historical dividend policy of Down Under and expects that the firm's dividend rate will grow at a constant rate of 3.5 indefinitely. Analyst also determines Down Under's beta is 1.5, the risk-free rate is 4%, and the expected return on the market portfolio is 8%. Calculate the current value of Down Under's shares. So what we'll do is that we need to try and identify, have we been given historical dividends as depicted over here, D naught, historical or current dividends? So the key terms there that you should be able to watch out for is historical dividends, current dividends, past dividends. That one should signify the D naught, and you should be able to grow the D naught so that you can be able to have the expected dividends and forecasted dividends into that. The D1 represents the forecasted and future dividends. The G is the firm's growth rate, and R is the cost of equity or required return. Now in this case, we have been given the following inputs. So the key word there is D naught. So we have, I just pick that one over there, Control C. I pick that, and I can be able to paste it down over here, Control V. So the solution down over here, solution there. And because I do not want it to be bolded, Control B, like that. And so if I have the D naught, because we've been told the recently paid a dividend of 1.8 Australian dollars. So that's the value there. So if I can be able to just move down or control up. So we move up like this, my apologies. We can just move down like this just to bold. So we unbold that, so Control B, that, and of course because I can see that it seems to be bolding, I just press Control B like that, and also this part over here, Control B like that, so that now when I write subsequent inputs towards the formula, then they'll not be bolded. So D naught is 1.8. What else have we been given? We've also been given the dividend, the firm's dividend rate will grow at a constant rate of 3.5%. So the G has been given to us over there as 3.5%. Fine, that's fine. And then what else have we been given? We've been given an analyst also determines that Down Under's beta. So the way to do it is that if you want to come to beta, you can just come to insert over here like that, and then we can go to symbols. So when we go to symbols, we can just click over here, symbol, like that. And then from symbols, we can try and look for beta right over here. I can see it, it is right over here. So we click that and insert it over there like that. And then we close this screen like that. And beta has been given us how much on this other side. So we are saying that the beta, pardon me for that, and the beta has been given as 1.5. And then we have the risk-free rate. The risk-free rate has been given to us over here as 4%. 4% RF. So capital RF has been given to us there as 4%. And then, of course, this RF should be the risk-free, should signify the risk-free rate. But if perhaps you'd want you to indicate, that should be subscript over there. So you press Control 1 right there, Control 1. And you can see over here, there's subscript over here. Click that, and then you say OK. So the F becomes subscript. That's the risk-free rate like that. So it's like that. So because we're just using some of the shortcuts that you've learned in the previous lessons, there is the expected return on the market portfolio. So it's ERM like that. So M should also be subscript. So Control 1 again, and then we highlight. So we cancel, we escape. Then you say we just highlight the M should be subscript. Expected return on the market. So we press Control 1. And then we come to subscript right down over here. Press OK. The expected return on the market portfolio is given as 8%, like that. So trying to put in a formula, we know R is given as, expected return on the portfolio, R is given as, we can put that is equals to, R is equals to RF, so let me write it and then I'll be able to edit it again, plus, open the brackets, ERM minus RF, then we have beta over here. So we just come back to insert symbol over here. So the keyword there is insert symbol, like that, and then you select the beta right over there. So you just insert that over there, then you close that. So that is the formula over here. This is the CAPM formula, CAPM. So CAPM. Like that. So this should be, of course, control bold B, like that, you put it like that. And of course, editing is just something that, of course, you'd have to do, you'd have to learn to do, like that. So we press Control 1, subscript. Just press subscript there, like that, and then also RM, M should also be subscript. So Control 1, then you come to subscript, like that, then you press OK, like that, and our formula is done. So this is required return. Remember, we've already provided the cost of equity or required return, so R, because we've been given the inputs towards calculating required return. We have the RF right over there. So we have also the ERM, and the RF has been given, the beta has been given. So you just apply it over here. So we have all of the inputs, and I can, of course, explain it down. So so our required return is given as we put the inputs there, RF there, then we put in the values over here. So then I can just delete over here. So required return is given as, we're just following the formula, RF, so we put the formula plus, so we come RF like that, plus, we open the brackets, ERM minus RF, like that. Then we close the brackets over here, and then we multiply this. So we multiply that by the beta. So where is the beta? By that value over there. So how much do we get? Enter 10%. So our required return is 10%, which is going to be our R right over here, R. G over here is going to be already been provided as 3.5%. But remember, we've been given D naught because the keyword there we've been told is recently paid. So it has to be historical. We have to grow it over there. So we're saying our price, market price, or intrinsic value, that is equals to there's no need for I can just copy this over here, Control C, come down over here, paste it down over here, Control V, pardon me. So I just copy, come over here and just paste it down over here, Control V, like that. So it's equals to that. That's what you're saying is our market price, guys. So it's slot in the values over here. So market price using the single stage model is given as is equals to plus the D naught. So we go up times, we're just following this formula, 1 plus G, open the brackets, 1 plus, what is our growth rate here? Our growth rate is there, 1 plus G, divided by, so because we're dividing all of that, the entire numerator by this denominator, R. Where is our R? Remember, we calculated it over here, and you can be able to convert it into percentage over here. First of all, R minus G, and our G is how much? 3.5%. So we close the brackets over there, and we say equals 28.66. So this is what we can say as the market price over here, and this is the single stage DDM. In our next lesson, ladies and gentlemen, we are going to do the two-stage DDM, and the two-stage DDM will also apply a similar kind of approach where we'll be able to explain to you what the single stage formula DDM, two-stage, not the single stage, the two-stage DDM is all about. And then I'll walk you through a question that will be able to do it physically on Excel. Thank you for being with Manifested Publishers. God bless you. Welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and I am a practitioner within the financial services industry in Kenya. Today, ladies and gentlemen, we are going to discuss about the two-stage DDM right here. In our previous lesson, we had introduced the single stage DDM, and just by checking this tab down over here, I can demonstrate to you how different the single stage DDM is from the two-stage DDM. We provided the assumptions of the single stage DDM, and we said that the single stage DDM will continue, like the growth rate in dividends will continue into the foreseeable future. Unlike the single stage DDM, the two-stage DDM has got two stages of growth. As you can be able to see on this graph over here, the first dividend growth rate grows at 10%, and then it declines suddenly to 4%. That is, the dividend growth rate declines to 4% into the foreseeable future, period 9, 10, 11, and so on and so forth like that. So this model is based on certain assumptions. The first assumption is that the firm is expected to grow at a higher growth rate in the first period. So you can see the growth rate over here is higher as compared to the second stage growth rate. Assumption number 2, the growth rate will drop at the end of the first period to stable growth rate. So this is the first period right over here. I can be able to probably denote that using maybe colors there. So if I use the tabs or my keyboard over here, you can see I can be able to click on home over here, H. So what I did first is that I pressed Alt, then I went to H, then I'm going to H, and then now I can be able to see that FC represents this color right over here like that. So I'm not interested in highlighting the color, or I could be able to decide to select H over here. So let's select H. So I've selected H, and then it gives me the options. Which color do I want over here? So now I come over here and select probably that color over here. That's the first stage of growth. Then we're told in second assumption that the growth rate will drop at the end of the first period to a stable growth rate. So this stable growth rate will continue after period 4. So if I'm to go like that, pardon me, I'm meant to go from this stage over here up to that part right over there, I can be able to give it a different color to signify the stable growth rate there. So Alt, H, then I go to H again and select a color of my liking there. So you can be able to decide to select maybe a different color, maybe green like that. So that's the stable growth rate there. The third assumption right over here indicates that the dividend payout ratio is consistent with the expected growth rate. And the dividend payout ratio is how much a firm pays out in form of dividends. How much it retains is called the retention ratio. So we are saying in this assumption that the dividend payout ratio is consistent with the expected growth rate. So on to the model itself right over here, guys. You can see the intrinsic value right over here is given as the summation of the first stage of growth rate over here, indicated by this 10% right over here. And then we'll add the perpetuity component, which is denoted by this part down here, this part here. As you can see, plus this part right over here is indicative of the stage of growth rate over here. Alt, then we can be able to press H, then we go to FC, pardon me for that, we can go to F, and then C. It selects the color. So which color am I interested in over there? Perhaps I'll give it maybe say maybe a red, color red there. Sorry, I'm just because I'm using the keyboard. Press enter there. So that is the perpetuity component over here. So the best way to explain this is to explain what these components are. So the D naught, in our case over here, we already explained it in the single stage DDM right here. D naught, we had said, is the historical or current dividend. Then we have now G. G is also explained as the dividend growth rate. R is the cost of equity or required return there. So what I can do is that I can just pick those values like that. I copy them, and then I go to the two-stage DDM and perhaps try and apply them via Control V. And you can see they've actually been represented right there. So what we haven't explained, we can be able to explain over here. The GS and the GL. So I insert over here, line like that. I also insert again. So to insert, you press Alt N, and then you can insert maybe say a new, not a new table, just a new row over there. Insert, you just insert like that. So we can then proceed on to explain the GS, and then GL. Then we also explain what the N is, because we haven't explained what the N is. You can see the N is given to us right there. N. So because they are all bold, we just highlight and control B. Put them in bold. We start explaining what GS is. Short-term growth rate. So, short-term growth rate. This is the long-term growth rate. Term growth rate. Then we have N, represents length of high growth period. Length of the high growth period. Period there. As usual, you continuously save your work. Control S. So because we have provided inputs to what we are to use, I can insert over here. I'm aligned to just separate this, you know, the values of what you're trying to explain, as well as the question which you're about to do right over here and the assumptions right here. So there's a question I'm going to read for you right over here, and then we will apply the two-stage model. So Sea Island Recreation currently pays a dividend of 1. The analyst forecasts growth of 10% for the next 3 years, followed by 4% growth rate in perpetuity thereafter. The required return is 12%. Calculate the current value per share. So we need then to identify what inputs we've been given. So solution. Control B, bold as usual. Then we list what we've been given. Have we been given all of these inputs over here? So I just copy that. Control C, come down over here and paste them right down here. Control V. Then we correspondingly put the values beside those inputs. So currently pays a dividend. So the keyword there is currently pays. So we're dealing with D0, not D1. When we use D1 is when we'll be able to expect to see forecasted dividend, future dividend, and so forth there. So we're saying we put that as 1. Then we've also been given the growth rate for the next 3 years. So as you can see, based on our graph right over here, we expect to grow it for 3 periods, and then it declines all of a sudden to, say, 4% into the foreseeable future. So in the first case, we're saying the forecast growth rate is 10%, 10%, the keyboard there. So this is S1, stage 1. 1 there, so you put Control B. And then required return, which you've been given, is 12%. It's direct there. The growth rate in the short term, we've been given so there's one thing, guys, that I didn't perhaps explain, is this dividend growth rate. So I should delete this one over here because we've got 2 growth rates. We do not have G alone. You can see there's GS over here and there's GS here, there's GML. This should be GL right there. So I change the formula GL correctly over there, and then I put a subscript on it, of course. I put subscript on that value there. So Control 1, and then you click on subscript. You can see it right here, subscript. And I press OK. So it goes down over here as well. This one should also be subscript. This GL should be subscript. So control 1 subscript down there. So pardon me, so I just delete this part over here, shift delete, it goes back up. Then I go back now to that column over there like that, and then like that, then I delete this one over here. So shift delete, it goes back up like that. So we're saying we have the GS, the GL there. So the GS was now what I was explaining, 10%. 10%. That, pardon me for that. Then the GL represents the growth rate in the long term is 4%. 4%. And then we go number of periods, our N right there, which represents the length of the high growth period. The high growth period right there. So we're saying our N in this place, in this case, is going to be the 4%. Number of periods over there in the high growth period is going to be in perpetuity over there. So here we don't need to really put it into perspective, or we don't really need to give a value over there because it's growing indefinitely like that. So to get the V naught, so we just copy here's this value over here, copy, and then we come back down over here because that's the intrinsic value that we're getting, control V. That. So what we need to do is that we get this summation part over here. So we have right here plus the D naught, the first the dividend is 1 into or times into 1 plus GS, growth rate in the short term. Growth rate in the short term. So 1 plus, what is the growth rate in the short term? You can see GS is 10%, 0.01. 1 plus that value, let's put the values like that, and then power, shift 6. You can see on your keyboard shift and 6, that represents power. Power 1, and then we're discounting that divided by, open the brackets, 1.12, 1 plus 12%. Why are we getting 12%? Because it's 1 plus R right here, guys. Like that. Power, shift 6, and then power 1. So that represents the first year. Then, because we are saying that these ones, we need to press them in, we are going to do it for 3 years because we've been told the period is going to be 3 years. So we can then insert a new set of brackets there. So, like that. So this is, then we open another bracket like that. Then we close this first bracket like that. So that represents the first year. Plus, we can copy this that, control V there, to represent now. So it's 1, so it's the D naught 1 times 1 plus GS times 1 plus GS power 2. Power 2, and here we have power 2. Power 2, like that. And then we control V, we paste. Now power 3 for 3 years, guys. Power 3, so delete 3. So, and then this plus over here, so I first of all close this bracket like that. And then, because this first bracket, and then I close this first bracket, and then we've opened it 3 times. 1, 2, 3. So you're supposed to close it once. That's the first time we've closed it. This first bracket has been opened, has been closed by that one. This one has been opened, has been closed by that one. This one I need to first of all also delete that so that can be correct. Plus 1 plus G, that one has been opened and is closed by that one. I perhaps need to first of all check D naught times 1 plus GS power 1 over 1 plus R power 1, like that. So this one needs to be closed by 2. Needs to be closed by 2. So that one like that. Over 1 plus this one power 1, yes. So this one is D naught times 1 plus GS power 1 all over, we open the brackets, 1 plus R power 1. We close the bracket like that. So the formula seems to be okay as far as that is concerned. So this is power 1, power 2, power 2, power 3, power 3, like that. Then now we are adding this perpetuity component over here. So we repeat this part over here. This part here. Sorry. So we just repeat it, Control V. Over here. So we first of all undo that again, and I can redo it my second time. So it is just going to be given as we can put plus D naught times, open the brackets, 1 plus GS. Who is our GS? There, you can see it's our GS. Close the brackets. So we need to first of all open twice the brackets so that it can be all inclusive. And then power, shift power. Shift 6, that shows the sign of power, power 1. Then we close the brackets like that. And because we need to open the brackets right here so that we can discount divided by, open the brackets, 1 plus R, 1 plus R, close the brackets, and then we close the brackets again. So once we've done that, that is for power 1, guys. So let's repeat the same. Copy, plus, Control V. Instead of power 1, we have power 2. Power 1, this should be power 2. Over here should be power 2. Shift 6, power 1. And then we copy this now. This is correct, like that. Power 1, yes, so we copy up to there. So copy, and then this part now ceases to exist. And Control V. Now that's power 1, so this is power 2. Power 2, power 2, like that. And then we repeat for power 3. So it accepts the correction, so we correct it over here. And then we open it up over here. So this is power 2, power 2. Yes, so now we copy this, copy. Then we plus Control V. Now instead of saying power 2, we say power 3. Delete power 3, power 3. So what do we get? We get that. So that is this component over here, the summation part. And that's why we're saying it is going to be summation. So we are adding that power 1 up to there. That's for power 1. Then this part represents power 2 up to there. And then this part represents power 3. So we are getting the sum of this value, and I don't have gotten that. So once we have that, escape, we come back down over here and now compute this perpetuity component. Perpetuity. 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 So this is not the V naught over here, I can delete that. This is the growth, high growth phase. High growth phase. So I can just double click here. That's too wide. So just what we do is that we just open it just marginally small like that. Or we can decide to home and then Alt H, and then we try and text trap. Text trap is W, like that. So high growth phase value. The perpetuity, now we're going to work out this part over here. So it's going to be plus D naught times what? 1 plus growth rate in the short term, the last period, like that. So what we do, instead of just rewriting it again, we can just pick the last period over here. Double click. We copy this part over here. Power 3, power 3. Copy. Then we insert it. We just place it here, Control V. That. So it's going to be plus. So we open the brackets. That. So we've repeated just this part over here. So we've just repeated this part over here. This part over here. All over 1 plus R. Power 3, power 3, power 3, power 3. Like that. So for simplicity's sake, let me just do it like this. So the perpetuity will be that, and then I cut this part over here, cut. So this part over here represents just that part up to there. Then, if you allow me, I multiply that times 1 plus GL. So open the brackets, 1 plus plus GL, that part value there, times 1 plus GL. Oh, I've not put a plus over here, so it needs to be a formula. Plus 1 plus GL. Now it's active, you can see. Growth rate in the long term. We close the bracket there. So we've just done the numerator of the perpetuity component. D naught, which is B20, times 1 plus GS, the previous period, power 3, times 1 plus B23. B23 is GL, 1 plus GL. So we press enter comfortably there, and it corrects for us. That's the numerator of the GL. Numerator. And then denominator of the perpetuity component, denominator. There. So what we do, the denominator, 1 plus R plus 1 plus R. What is our R? 12%. Close the bracket. So I didn't open the brackets first, so I just open it there. Open it again. Power, shift 6. Power what? Power 3 yes, because it's the last period. This n is power 3. And then what do we do? Times, we open the brackets, r minus gl, r times, open the brackets, r minus gl 4%. Close the bracket. Let's confirm if everything is okay. 1 plus r, so it's 1 plus b21. B21 is r, yes, multiplied by power 3, sorry, power 3. So you need to have put a bracket over there, like that. Then times B21, 12%, R minus GL. So if you're comfortable with that, we just press enter and it will give us that value. So perpetuity component, I can just keep one line there. Perpetuity, we're saying we have the numerator divided by the denominator. So plus the numerator divided by the denominator there. How much do we get? We get 12.31. Once we get 12.31 over here, so the high growth phase, perpetuity phase. So the V naught, our value, market value is given as plus the high growth phase plus the perpetuity component there. How much do we get? 15.21. And this can be bolded as our value right over there. We can even decide to change the color. So Alt H F C. Which color would we prefer? Should we prefer to put it, maybe say red? Let's put it red as our intrinsic value. And you press enter. That's it. So that's the market value, ladies and gentlemen, using the two-stage DDM. We first of all compute high growth phase value right over here, which we've done using the formula over here. And then we then compute the numerator and the denominator to avoid confusion. So these two over here, then down like that. You can press Control B, change the color, Alt H F C, put it a different color. We can use maybe say perhaps blue, like that. Enter. So that once you get the numerator, we divide by the numerator, we get the perpetuity component, which is that value there. So to get the market value right here, you can see is just even in the formula bar right above over here, sorry, the formula bar right over here, you can see B27 plus B31. So you double click it, it gives us the high growth phase plus the perpetuity phase. We get the market value as 15.21. Hope you have enjoyed this lesson. Thank you for being with Manifested Publishers as we continue demystifying equity valuation models using Excel. I stop. Hello learner, welcome to Manifested e-learning platform. My name is F.A. Mlingwiri and I practice within the financial services industry in Kenya. Ladies and gentlemen, today we are discussing about equity valuation models. To begin this lesson, we are going to discuss about the dividend discount model, single stage, two-stage, and multi-stage models. So this is Excel, and what I've done is that the usual cells have actually been done away with. Say for example, I've actually come here and I decided to, you can see the colors over there. So I decided if I put no fill right over here, you'll be able to see the typical Excel worksheet like that. But for simplicity's sake, or for even for visual presentation, I felt it would be good for us to come right there, and then we put it a white background like that. So the discounted dividend model is a model that was, or what we can say the constant growth model, was developed by Gordon. And under the single model, it assumes that the firm expects to pay a dividend in 1 year. So we can say, so we can write that the firm expects to pay dividends in year 1, in 1 year, in 1 year. The second assumption is that dividends grow indefinitely at a constant rate. Dividends grow indefinitely at a constant rate, indefinitely. Yes, so that is it there. And finally, the third assumption is that the growth rate is less than the required return. The growth rate is less than the required return. So those are the assumptions, and for simplicity's sake, what I can be able to do is that I can select all of them, the 3 assumptions, as I move down like that, and then I press Control bold, and then Control bold, it will unbold that. So if you press Control B, I'll bold that. Control B again, it will unbold that. So these are the assumptions of the DDM. And under the DDM, specifically the single stage DDM, it assumes that the firm expects to pay a dividends in 1 year. So this is the historical dividends, the D naught, then 1 plus G. So if I grow it by a factor of G, which is assumed to be constant, then I should be able to get the expected dividends, the future dividends, and so on and so forth. So the firm expects to pay dividends in 1 year. Dividends grow, the next assumption is that dividends grow indefinitely at a constant rate. So the growth rate is constant, and this graph depicts that constant growth rate. So you can see the 3.5% dividend is constant, or the growth rate in dividends is constant from time 0 through to time period 9, and indefinitely moving towards the right there. So this graph tries to explain this second assumption. The third assumption is that the growth rate should be less than the required return. So the R should be less than the G, like that over here. So if I can put brackets onto this part right here, that to represent constancy, this model and this one over here, the best way to try and apply this on Excel is by looking at an example. So the example on your screen reads as follows. Down Under Financial recently paid a dividend of 1.8 Australian dollars. An analyst has examined the financial statements and historical dividend policy of Down Under and expects that the firm's dividend rate will grow at a constant rate of 3.5 indefinitely. Analyst also determines Down Under's beta is 1.5, the risk-free rate is 4%, and the expected return on the market portfolio is 8%. Calculate the current value of Down Under's shares. So what we'll do is that we need to try and identify, have we been given historical dividends as depicted over here, D naught, historical or current dividends? So the key terms there that you should be able to watch out for is historical dividends, current dividends, past dividends. That one should signify the D naught, and you should be able to grow the D naught so that you can be able to have the expected dividends and forecasted dividends into that. The D1 represents the forecasted and future dividends. The G is the firm's growth rate, and R is the cost of equity or required return. Now in this case, we have been given the following inputs. So the keyword there is D naught. So we have, I just pick that one over there, Control C. I pick that and I can be able to paste it down over here, Control V. So the solution down over here, solution there. And because I do not want it to be bolded, Control B, like that. And so if I have the D note, because we've been told the recently paid a dividend of 1.8 Australian dollars. So that's the value there. So if I can be able to just move down or control up. So we move up like this, my apologies. We can just move down like this just to bold. So we unbold that, so Control B, that, and of course because I can see that it seems to be bolding, I just press Control B like that, and also this part over here, Control B like that, so that now when I write subsequent inputs towards the formula, then they'll not be bolded. So D naught is 1.8. What else have we been given? We've also been given the dividend, the firm's dividend rate will grow at a constant rate of 3.5%. So the G has been given to us over there as 3.5%. Fine, that's fine. And then what else have we been given? We've been given an analyst also determines that down under's beta. So the way to do it is that if you want to come to beta, you can just come to insert over here like that, and then we can go to symbols. So when we go to symbols, we can just click over here, symbol, like that. And then from symbols, we can try and look for beta right over here. I can see it is right over here. So we click that and insert it over there like that. And then we close this screen like that. And beta has been given us how much on this other side. So we are saying that the beta, pardon me for that, and the beta has been given as 1.5. And then we have the risk-free rate. The risk-free rate has been given to us over here as 4%. 4% RF. So capital RF has been given to us there as 4%. And then, of course, this RF should be the risk-free, should signify the risk-free rate. But if perhaps you'd want you to indicate, that should be subscript over there. So you press Control 1 right there, Control 1, and you can see over here there is subscript over here, and click that, and then you say OK. So the F becomes subscript. That's the risk-free rate like that. So it's like that. So because we're just using some of the shortcuts that you've learned in the previous lessons, there is the expected return on the market portfolio. So it's ERM like that. So M should also be subscript. So Control 1 again, and then we highlight. So we cancel, we escape. Then you say we just highlight the M should be subscript. Expected return on the market. So we press Control 1. And then we come to subscript right down over here. Press OK. The expected return on the market portfolio is given as 8%, like that. So trying to put in a formula, we know R is given as, expected return on the portfolio, R is given as, we can put that is equals to, R is equals to RF, so let me write it and then I'll be able to edit it again, plus, open the brackets, ERM minus RF, then we have beta over here. So we just come back to insert symbol over here. So the keyword there is insert symbol, like that, and then you select the beta right over there. So you just insert that over there, then you close that That. So that is the formula over here. This is the CAPEM formula, CAPEM. So CAPEM. That. So this should be, of course, control bold B, like that, you put it like that. And of course, editing is just something that, of course, you'd have to do, you'd have to learn to do like that. So we press control 1, subscript, let's press subscript there, like that. And then also RM, M should also be subscript. So control 1, then you come to subscript, like that. Then you press OK, like that, and our formula is done. So this is required return. Remember, we've already provided the cost of equity or required return. So R, because we've been given the inputs towards calculating required return, we have the RF right over there. So we have also the ERM, and the RF has been given, the beta has been given. So you just apply it over here. So we have all of the inputs, and I can, of course, explain it down. So so our required return is given as, we put the inputs there, RF, there. Then we put in the values over here. So I can just delete over here. So required return is given as, we're just following the formula. RF, so we put the formula plus, so we come RF, like that, plus, we open the brackets, ERM minus RF, like that. Then we close the brackets over here, and then we multiply this. So we multiply that by the beta. So where is the beta? By that value over there. So how much do we get? Enter 10%. So our required return is 10%, which is going to be our R right over here, R. G over here is going to be already been provided as 3.5%. But remember, we've been given D naught because the keyword there we've been told is recently paid. So it has to be historical. We have to grow it over there. So we are saying our price, market price, or intrinsic value, like that, is equals to there's no need for, I can just copy this over here, Control C, come down over here, paste it down over here, Control V, pardon me. So I just copy, come over here, and just paste it down over here, Control V, like that. So it's equals to that. That's what you're saying is our market price, guys. So we slot in the values over here. So market price using the single stage model is given as is equals to plus the D naught. So we go up times, we're just following this formula, 1 plus G, open the brackets, 1 plus, what is our growth rate here? Our growth rate is there, 1 plus G, divided by, so because we're dividing all of that, the entire numerator by this denominator, R. Where is our R? Remember, we calculated it over here, and you can be able to convert it into percentage over here. First of all, R minus G, and our G is how much? 3.5%. So we close the brackets over there, and we say equals 28.66. So this is what we can say as the market price over here, and this is the single stage DDM. cut.
Iko sawa.
Iko sawa. Hiyo ni single stage DDM.
Haujafunga.
How do you close?
Tibu kwanza tunini alafu tufunga. So kufunga maybe tuambie nini?
Oh, because I've not nini bado sijafunga. Okay.
Tuambie
This is so just I can just nini because uta shorten hiyo nini hiyo gap si ndio?
Ifunge tu lesson mwambie next lesson kitu tadu.
Okay. In our next lesson, ladies and gentlemen, we are going to do the two-stage DDM. And the two-stage DDM will also apply a similar kind of approach where we'll be able to explain to you what the single-stage formula DDM, two-stage, not the single-stage, the two-stage DDM is all about. And then I'll walk you through a question that we'll be able to do it physically on Excel. Thank you for being with Manifested Publishers. God bless you.
Hello everyone and welcome to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to start revising the paper that was done in December 2023 by the CPA Advanced Level candidates. This question paper has 5 questions. Candidates were required to answer all questions, and we will be answering a question at a time. In our today's lesson, we'll answer question 1. In our next session, we'll answer question 2 until we complete the 5 questions. I urge you to attempt the questions before attending these lessons. Make sure you do the questions on your own before coming to this revision session. So let us begin by answering question number 1, which reads, Part A, you are the audit manager of Baraka and Company LLP, who are the auditors of Miradi Limited for the year ended 30th June 2023. The company has net assets of 150 million. The audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi have resolved that depreciation on buildings will not be provided for in the financial statements. The buildings were acquired in the year 2020 and no depreciation has been provided since. Required Roman 1, describe 6 additional audit procedures and actions that you would take with respect to the above matter. So candidates, here is a problem with the Baraka, Miradi Limited. This is a company that whose net assets are valued at 150 million. But the item on depreciation, we learned that depreciation has not been provided for on buildings since the buildings were acquired in the year 2020. Candidates were required to describe 6 additional audit procedures and actions that could be taken in respect to the above matter. So let us put down the audit procedures, additional audit procedures. This is December question 1. A, Roman 1. What are the additional audit procedures that the auditor should perform in respect to buildings? Now, candidates, the first audit procedure is to review the accounting policies. The auditors should review the accounting policies of this company, the Miradi Limited company. The auditors should conduct thorough review of Miradi Limited's accounting policies related to depreciation, specifically focusing on the treatment of buildings. The auditor should evaluate In carrying out the review, the auditor should evaluate the consistency of the policies with applicable accounting standards and also the regulatory requirements. Review of accounting policies, because candidates, every company must have accounting policies on different matters. For example, on the estimation of depreciation, company must have accounting policies in relation to depreciation. And therefore, given that there is a problem on the buildings, we've read that the audit has been completed, but there is a matter that has not been resolved on depreciation of buildings. So as the auditors ought to review the accounting policies related to buildings. And in reviewing the accounting policies on buildings, the auditor should evaluate the consistency of the policies with respect to accounting of or treatment of the depreciation on buildings. 2, assessment of the methodology on depreciation. Assessment of depreciation, let me call it depreciation methodology. The auditor should assess the methodology on depreciation. The auditors ought to evaluate the appropriateness of the depreciation method that is applied to buildings. This means assessing whether the straight line method is reasonable or any other method of depreciation. So there are the various methods that the company may use. The straight line method or reducing balance method. So the auditor should evaluate the appropriateness of the method that is used to depreciate buildings. Assess, for example, whether straight line method is reasonable or not. The auditors may also consider alternative methods and their potential impact on the financial statements. There are various methods: the reducing balance method, the straight line method, and so on. Assessment of depreciation methodology. 3 is another audit procedure is in relation to documentation. Inspection, let me call it inspection. The auditor should inspect the documentation related to buildings, of building documentation. Inspection of building documentation. The auditor ought to physically inspect the documentation related to buildings, including purchase agreements, title deeds, and any other relevant contracts. And by so doing, the auditor can verify the accuracy of the acquisition costs and also ensure that no impairment or changes in the useful life have occurred since acquisition. Inspection of buildings documentation. You understand? That is, if the building was bought, then there has to be agreements. If the buildings were constructed, then there are documents related to construction of buildings. So the auditor should inspect the documentation related to buildings. Whether the buildings were bought or even constructed by the company, there are various documents that ought to be inspected, like the title deeds, the relevant contracts, the purchase agreements, and so on. So candidates, we are discussing the additional audit procedures that the auditor should carry out in relation to building of Miradi Limited, a company that has refused to depreciate buildings. We read from the question that the audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi Limited have resolved that depreciation on buildings will not be provided for in the financial statements. So what audit procedures, additional audit procedures, should the auditors perform? The fourth audit procedure is evaluation of maintenance expenditure. You understand? Evaluation of maintenance expenditure or expenditures. The auditor should evaluate the maintenance expenditures. The auditor should review the company's records of maintenance expenditure that is incurred on buildings since acquisition. We saw that these buildings were bought in the year 2020. The auditor is carrying out the audit in the year 2023. So since 2020, what are the maintenance costs related to buildings? The auditor should assess, should evaluate, should review the company's records of maintenance expenditures incurred on the building since acquisition in the year 2020. The auditor should assess whether there are significant repairs or whether there have been improvements that have been capitalized, or whether there are any improvements since the buildings were acquired. Assess whether any significant repairs or improvements have been capitalized, and whether the expenses have been appropriately distinguished from maintenance costs. You understand? Because there are certain costs that are incurred on buildings that ought to be capitalized. Other expenses on buildings may be part of the normal expenses of for the company. So that assessment has to be done, and the auditor can only do that after evaluation of the maintenance expenditures. 5, comparison. The auditor can do a comparison with industry standards. What are the industry standards? That means that the auditor should do what we call benchmarking. Benchmark the company's depreciation policy and practices against industry standards and norms, and consider factors such as the average useful life of the buildings in the industry sector, and also the common depreciation rates used by peer companies. So this is Miradi Limited. We are not been given information on the industry in which this company operates, but whatever industry it is, whether it is a banking industry or agriculture industry or whatever industry, the auditor should benchmark the practices within the industry vis-a-vis what the company is currently doing in relation to buildings. What are the depreciation policies? What are the practices in the industry? And what are the standards? What are the norms in the industry compared to what the company is doing? Because industries may have certain average useful life for buildings. The companies may have a common depreciation rates that are used within that industry. So the auditor should compare the rates, should compare the various factors in relation to buildings compared to what happens in the industry. So comparison with industry standards. So this is an additional audit procedure. Another procedure is in relation to communication with third parties. communication with third parties. These third parties could be experts or independent appraisers, industry experts, and so on. The purpose for this procedure is to obtain their opinion on the appropriateness of the company's depreciation policy and the condition of buildings. Do you understand? These are third parties, like experts, appraisers, and so on. Communication with third parties. Industry experts. So these are some of the audit procedures. They are not the only audit procedures. There are more. There could be more, but these are 6 audit procedures that the auditor can perform in relation to the buildings of Miradi Limited Company, which has not been providing for depreciation on buildings for the last 3 years. So the auditor here, I'm saying, should seek validation or additional insight to support audit findings. So these additional procedures candidates aim to enhance the auditor's understanding of the depreciation matter. These audit procedures may also help the auditor assess the impact of the decision not to provide for depreciation on the financial statements, and also to ensure compliance with accounting standards and regulatory requirements. That is the solution to that part. Additional audit procedures: number 1, review accounting policies. Number 2, assessment of depreciation methodology. Number 3, inspection of buildings documentation. Number 4, evaluation of maintenance expenditures. Number 5, a comparison with industry standards. Then lastly, communication with third parties. That is part A, Roman 1. A, Roman 2, assume that according to your workings, the depreciation charge on buildings for the year ended 30th June 2023 should be 4.2 million based on the straight line method of depreciation at an annual rate of 5%. Required, discuss the implications of the above on the financial statements, clearly indicating its effect on the audit report. This is Roman 2. We have to discuss implications of the above on the financial statements. The above is assuming, according to your workings, the depreciation charge on the buildings for the year ended 30 June 2023 should be 4.2 million on the straight line method depreciation at an annual rate of 5%. What is the implication of this? What is the implication if the depreciation was to be 4.2 million? What is the implication on the financial statements? This question is in 2 parts. Implication on the financial statements, then clearly indicating its effect on the audit report. We'll also discuss the effect of this information on the audit report. But first of all, let us discuss implications on the financial statements. Failure to provide for depreciation on buildings, despite being required by accounting standards candidates, has several implications on the financial statements and consequently on the audit report. So what are these implications on the financial statement? The first implication is overstatement of assets. Overstatement of assets. Now, since depreciation represents the systematic allocation of the cost of an asset over its useful life, not recognizing depreciation results in overstatement of the carrying amount of buildings on the balance sheet. And in that case, the building's value would remain at their original acquisition cost. leading to an inflated asset value. So ideally, depreciation is to reduce the cost of the building. But if depreciation is not charged, then the assets will be overstated. The asset will be overstated. We read from this question that the company has a net asset of 150 million. This is a total value of assets. That tells you that the value of 150 million is overstated because of the fact that the company does not provide for depreciation. And if this company has not been providing for depreciation for the last 3 years, and we have read in note number 2 that the depreciation charge, the auditor may have carried out this depreciation to be 4.2 per annum. If the depreciation charge is 4.2 per annum, and this company has not provided for depreciation for the last 3 years, you can see, candidates, the depreciation charge, the accumulated depreciation is 12.6 million. So that means that the total value of assets, the net assets of 150 million is overstated by 12.6 million. That is the implication of not providing for depreciation on assets by this company. That's the first implication. The second implication is the overstatement of net income. The net income is overstated as well, because depreciation expense is deducted from revenue to calculate net income. And by not recognizing depreciation, the company's reported net income would be higher than it should be. And in this scenario, the absence of depreciation charge of 4.2 million would lead to the overstatement of net income, thereby distorting the profitability of the company. So for example, if the company recorded a net profit for this year of say 30 million, that means that net profit is overstated by 4.2 million. So that is the impact of not providing for depreciation on buildings. Number 3, distorted financial ratios. Distorted financial ratios. Now, the overstatement of assets and net income due to the omission of depreciation affects various financial ratios. For example, the return on assets ratio would be inflated, giving a false impression of the company's efficiency in generating profits from assets. Similarly, the debt to equity ratio could also be affected, as the inflated assets would lead to a lower leverage ratio. You may have other assets like the return on capital or return on capital employed, which is calculated by getting the ratio between the net profit and sales, or net profit and return on capital employed. So the omission to depreciate buildings could lead to distorted financial ratios. Why? Because the assets are inflated, net income is also inflated, and that could affect various financial ratios. That is an implication of not providing for depreciation on buildings. 4, misrepresentation of the financial position of the company, of the financial position of the company. Misrepresentation of the financial position of the company. Financial statements are meant to provide a true and fair view of a company's financial position. So failing to recognize depreciation results in misrepresentation of the company's true financial position by overstating assets and overstating profitability. And these misrepresentation candidates could mislead stakeholders, including investors, creditors, and even the regulators. So that is the fourth impact for not providing for depreciation on buildings. The question required candidates also to highlight the effect of this omission on the audit report. If I can take the question again, discuss the implications of the above on the financial statements. So these are the impacts on the financial statements, clearly indicating its impact on the audit report. Impact on audit report. What is the impact of this omission on audit report? Impact on audit report. Now, the auditor would need to issue a qualified or adverse opinion. The auditor may need to issue a qualified or adverse opinion. As a result of these effects of omission of depreciation of buildings on buildings, as a result of these effects or this omission of depreciating buildings has effect or impact on the audit report. One impact is that may lead to issuance of a qualified or adverse opinion. And that whether the auditor issues a qualified or adverse opinion depends on the materiality or the pervasiveness of the issue. And candidates here, a qualified opinion would be issued if the auditor concludes that the failure to recognize depreciation results in a material misstatement of the financial statements, but is not pervasive. On the other hand, an adverse opinion would be warranted if the auditor determines that the misstatement is both material and pervasive, meaning that it affects multiple areas of the financial statements. So that would be one impact. That may lead to issuance of a qualified opinion or adverse opinion depending on the materiality of and pervasiveness of the error. The audit report number 2 may also include a section discussing the basis for qualification or adverse opinion. There would be an additional paragraph. The audit report would contain a section. You understand? Discussing the basis for qualification or for issuing an adverse opinion. And this section would explain the reasons for the auditor's conclusion, including the failure to recognize depreciation, including the impacts of this omission to depreciate buildings on the financial statements. It would also highlight the departure from accounting standards and regulatory requirements. Additional paragraph. There will be a section explaining the impact of this mistake on the and so on. So these are two impacts on the audit report. Now, candidates, in concluding this part of the question, we can say that the failure to recognize depreciation on building has significant implications for accuracy and reliability of the financial statements, requiring appropriate disclosure and also qualification in the audit report in order to inform the stakeholders of the limitations of the financial information that has been presented. So the auditor has a duty to inform the users of the financial statements of the failure by the management to depreciate buildings. Failure to recognize depreciation on buildings has significant implications for the accuracy and reliability of the financial statements. You've seen how the failure of this failure can lead to implication on the assets. It has implications on the net income. It has implications on financial ratios. It has also implication on the truthfulness and the fairness of the financial statements, because we know that financial statements are expected to portray a true and fair view. But if there is an omission in depreciation, that can lead to misrepresentation of the financial position, which means that the financial position of the company as presented by the management does not present a true and fair view. So that is question A, part 2 had 8 marks. 1, 2, 3, 4, 5, 6. Any 4 points there would earn you 8 marks. Part B, audit risks associated with audit of financial statements. Now, candidates, financial instruments, we all know, present unique challenges for auditors due to their complexity and due to their inherent risks. So what are some of the audit risks that are associated with the audit of financial statements? So if you are to audit financial statements, what are some of the risks that are associated with audit of the financial instruments? Not statements, but instruments. Audit risks associated with audit of financial instruments. The first audit risk is the valuation risk. Valuation risk. Now, financial instruments are often valued using their fair value estimates, which can be subjective and prone to error. So auditors need to assess the appropriateness of valuation techniques, and the auditors also may need to assess the underlying assumptions used by the management. So when auditing financial instruments, the auditors must pay attention to the appropriateness of the valuation techniques and also the underlying assumptions that were used by the management to value the financial instruments. So valuation risk is an audit risk associated with the audit of financial instruments. 2, model risk. Model risk. Now, complex valuation models are sometimes used to determine fair value. And these models can be flawed or can contain errors leading to misstated financial instruments or even misstated financial statements. So auditors need to evaluate the control around model development and their use. So financial instruments are valued based on certain models. So they could also be errors in the development of these models, which can pose model risks. And when auditing these financial instruments, the auditors ought to pay attention to the models and the risks and how they are developed. There are also inherent risks associated with the audit of financial instruments. Number 3, inherent risks. Financial instruments are inherently risky due to factors like market fluctuations, factors like creditworthiness of the counterparts, and also liquidity issues. So the inherent risk associated with the specific instrument can be high, requiring extensive audit procedures. Inherent risks. 4, control risks. There are also control risks associated with the audit of financial instruments. The internal controls surrounding financial instruments may be weak, they may be ineffective, and that could allow for errors or fraud to go undetected. So auditors need to assess the design and also the operating effectiveness of controls related to financial instruments and also related to transactions around financial instruments and valuation. Control risks. Lastly, we have classification risk. There's also risk associated with classification. Financial instruments can be complex and may be incorrectly classified in the financial statements. And this misclassification can have a significant impact on the reported financial position and results. So auditors need to understand the classification criteria, and also they need to test the company's classification processes. Classification risks. There's also disclosure risk associated with the audit of financial instruments. Disclosure risk. The financial statements may not adequately disclose the nature and the extent of the risk associated with financial instruments. And insufficient disclosures candidates can mislead users of the financial statements. So auditors need to assess the completeness and the accuracy of disclosures related to financial instruments, like derivatives. So these are 6 audit risks. Candidates were to give 6 audit risks. 1 is valuation risk, 2, model risk, 3, inherent risk, 4, control risk, 5, classification risk, 6, disclosure risk. How many marks? These are 6 marks. 6 marks. Part A of the question, how many marks? This one, 6, this a point here, 6 marks. Then we have 6 part 2, implication on financial statements, 6 marks. These are 8 marks. Any 4 points will earn you 8 marks here. Total is 20 marks. So that is a suggested solution to the Advanced Auditing and Assurance December 2022 question 1. Thank you for attending the lesson. In our next session, we are going to answer question number 2. So please attempt question number 2 before joining our next session. Bye-bye. Hello everyone, and welcome back to the lesson. Today we are going to answer the last question that was tested in December 2023. So far we've done question 1 up to question 4. Today we attempt the last question, which is in two parts, Part A and Part B. Part A reads, highlight 6 reasons why it is necessary to make adjustments to accounts at the end of the accounting year. 6 reasons. Reasons why it is necessary to make adjustments to the accounts at the end of the accounting period or the accounting year. Why is it necessary to make adjustments to the financial statements at the end of the accounting year? Candidates, there are various reasons why it is necessary to make adjustments to accounts at the end of the accounting year. The first reason is the matching principle. Now, adjustments, candidates, help ensure that revenues and expenses are matched to the period in which they were incurred or earned. When comparing the financial statements, the accountants ensure that the revenues that were earned within that accounting period match with the expenses that were incurred. So adjustments are necessary so that this matching principle is adhered to. And this principle states that expenses should be recognized in the same period as the revenues they helped to generate. So if you have sales as revenues or interest or any form of income, that income has to be matched with the expenses that helped generate that revenue. That is the matching principle. And that's one reason why it is necessary to make adjustments to the accounting period such that the expenses that are being incurred that are not for the present period are not included in the present period, because there are times when candidates expenses that may be paid that do not relate to the current period. So such expenses should be deferred to the subsequent period. So that's why it's important or necessary to make adjustments to the accounts at the end of the accounting period. The second reason is accrual accounting. Many businesses use accrual accounting, which requires recognizing revenues and expenses when they are earned or incurred, regardless of when cash exchanges hands. And therefore, adjustments help reflect these transactions in the financial statements. Accrual accounting. 3, recognition of revenue. Some revenue may be earned but not yet received in cash. So adjustments ensure that these revenues are recognized in the appropriate period, which then provides a more accurate depiction of the company's financial performance. Expense recognition. Expense recognition. Now, similarly, candidates, certain expenses may be incurred but not yet paid. Some expenses may be incurred but not yet paid. For example, a company may use premises for the landlord without paying. Or a company may use the services of employees but fail to pay salaries and wages. So those are expenses that are incurred but not yet paid. So adjustments ensure that such expenses are recognized in the period they contribute to generating revenue and therefore improving the accuracy of the financial reporting. 5, accurate financial reporting. Now, adjustments ensure that financial statements present a true and fair view of the company's financial position and also the company's financial performance. And therefore, without adjustments, certain income or expenses may be understated or they may be overstated, leading to misleading financial statements. And therefore, it's important or necessary to make adjustments to the accounts so that the accounts portray a true and accurate financial position of the organization. 6, compliance with accounting standards. Now, many accounting standards and regulations require adjustments to be made at the end of the financial period and ensure that there is compliance, and therefore following these standards is essential for maintaining transparency, maintaining credibility in financial reporting. So adjustments may be made because there are certain transactions that are meant to be made in compliance with accounting standards. There's also tax compliance. Tax compliance. Tax compliance. Adjustments may also be made in order to comply with the taxation laws. And tax regulations often differ from accounting standards, and therefore adjustments may be required to reconcile the differences between the financial reporting and tax reporting. You are aware of the preparation of the income statements for tax purposes. The accounting that is necessary for reporting may be different from accounting for taxation purposes. So adjustments may also be necessary for tax compliance purposes. So adjustments be made to the accounts at the end of the accounting year in order to comply with tax regulations. So these are some of the reasons why it is necessary to make adjustments to the accounts at the end of the accounting period. And in summary candidates, making adjustments to accounts at the end of the accounting year is essential for ensuring accuracy, ensuring compliance, and also transparency in the financial reporting, which ultimately supports better decision making and the shareholders' trust, stakeholders' trust. So that is part A of that question. Part B of the question reads, the following are the financial statements of Utajiri Limited for the 2 years ended 30th September 2022 and September 2023. So we have the statement of profit or loss for the year ended 30th September. We have records for the 2 years in separate columns. Then there is also the statement of financial position as of 30th September for the 2 years. That is 2022 and 2023. Then down the statement of financial position, we have required, compute the following ratios for the years ended 30th September 2022 and 30th September 2023. Assume a 365 year, assume a 365 year, 65 day year. Assume a 365 day year. So the first ratio that candidates were required to calculate is the current ratio. So we're going to have columns here. Can I write here? Yes, I can write here. So we'll have the ratio. This column is the formula. Then the year 2022 and the year 2023. So the first formula is the current ratio. The formula for current ratio is current assets over current liabilities. That is the formula for current ratio. So we check for the year 2022 from the statement of financial position, the current assets. If you check the statement of financial position, that's 1710. 1710 divide by the current liabilities. Down there, current liabilities, you have tax payable, trade payables, and proposed dividends. That is 745. 745. So when we divide this, we get the current ratio for the year 2022, 2.3. 2.3 is the current ratio for the year 2022. Now, how about 2023? 2023, we have current assets 2195, current liabilities 610. So we divide 3.6. 3.6 times that means that current assets can pay current liabilities in 2022 2.3 times, in 2023 3.6 times. That is an improvement. That is a liquidity ratio. Then the second ratio is a quick ratio. Quick ratio. Quick ratio is equal to current assets minus inventory, total current assets minus inventory, divide current liabilities. So we take the total here, 1710 minus inventory. 2022 inventory is how much? 800. Divide the current liabilities. Current liabilities 745. 745. This is a liquidity ratio. The most liquid assets is 1.2. 1.2 times. Next, we have 2195 minus current inventory for the year 2023. Inventory is 1200. 1200 divide the liability 600. How much do we get? We have 2195 minus 1200 divide 610. This should be 610. 610. 1.6. 1.6 times. That is the second ratio, quick ratio. Quick ratio. Number 3 is average trade receivables collection period. Average trade receivables collection period. Collection period. The formula, this is, let me put it down. Average trade receivables collection period. The formula is average debtors we divide the annual credit sales, times 365. Now, candidates, the formula for average trade receivable collection period is equal to the average debtors divided by annual credit sales times 365. Now, average debtors is calculated by adding the opening debtors plus closing debtors divided by 2. That is the average. Now, for the period 2022, we do not have the opening debtors. What we have here is the closing debtors at the end. We do not have the 2021 data. We only have data for 2022 and 2023. So opening balance for debtors is not given in the question, and therefore we are going to use, we are not to get an average. We not use an average for this 2022, but we are going to calculate the formula using the debtors at the end of the accounting period 2022, which is equal to 490. 490 divide annual credit sales. Now, the annual credit sales, we pick this annual credit sales from the statement of profit or loss. The first item there is net sales in bracket 80% credit sales. So out of the 4.4 million shown there, 80% represent the credit sales. So we are going to calculate 80% of 4.4. 80% times 4.4. So the annual credit sales is equal to 3520, then we multiply by 365. So the average trade receivable collection period is 51 days. 51 days. 51 days. That is for the year 2022. For the year 2023, candidates, the average debtors will be the closing debtors for 2022, which is the opening debtors for 2023, plus the closing debtors for 2023, then divide by 2. That will give us the average collection, average debtors. So from the income, from the statement of financial position, we have the trade receivables, 490 plus 600. So this will be 490 plus 600. That is, we divide this by 2. That will give us the average debtors. Then we divide by the annual credit sales, which will be equal to 80% of 5.1 million. It's 4080. It's 4080 times 365 days. So let me get the average first. It's 49 days. 49 days. That is the average trade receivable collection period. It takes 49 days to collect money from the debtors. Collection period, average collection period. That's why we are using averages. Then the fourth ratio is known as, the fourth ratio is a gross profit margin. Gross profit margin, which is equal to the gross profit over sales times 100%. So what is the gross profit here? The gross profit is how much for 2022? It's 22. This is 2200. That's the gross profit. Divide by the sales, 4.4 million, times 100%. 50%. 50%. For the year 2023, gross profit is 2250. 2250 divided by the sales 5100 times 100 is 44%. That is the gross profit margin. Next is the interest cover. 5, interest cover. Interest cover. How do we calculate the interest cover? The interest cover is determined by dividing EBIT or operating profit over the interest charges times that way. It's not a percentage, but that is the formula. EBIT, earnings before interest and tax, or operating profit divided by the interest charges. For the year 2022, we check from the information given. Interest charges, we have the interest expense there of 45, just below the net profit before interest and tax. You have the interest charge, which is 45, and the operating earnings before interest and tax. Earnings before interest and tax, net profit before interest and tax is 1560. For the year 2022, 1560, we divide by the interest charge of 45. That will give us the interest cover. It's 35 times. That means that the earnings before interest and taxation is 45 times stronger. All right, for the year 2022. For the year 2023, the EBIT, earnings before interest and tax, is 1340. 1340 divided by 60. 1340 divided by 60. 1340 divide 60. 23 times stronger. The EBIT is 23 times stronger than the interest charges. That means that interest charges can be paid out of these earnings 23 times for the year 2023. That is interest cover. The next ratio is ROCE, return on capital employed. Return on capital employed. Number 6, return on capital employed. ROCE, return on capital employed. Return on capital employed is calculated by dividing EBIT over capital employed. EBIT over capital employed. Earnings before interest and tax. For the year 2022, we have 15, same as this one here. We divide by capital employed. Capital employed is the same as total assets minus current liabilities. From this question, capital employed is how much? Capital employed is the 1 million plus 915,000, giving us a total of 1915. 1915. 15. This is a percentage. A return is a percentage times 100, which is equal to 81%. 81. The return is quite high. 81% for the year 2022. For the year 2023, EBIT is 13 40. Capital employed 2023. Capital employed 2023 is 2785. 2785 times 100, that will be equal to, this is 48%. 48% is the return on capital employed for the year 2023. Then do we have any other ratio? Yes, earnings per share. Earnings per share. Earnings per share, that is number 7, EPS. Earnings per share. What is the formula? The formula is earnings after tax and interest. Earnings after tax. Earnings after tax and interest. We divide by the number of ordinary shares outstanding. Number of ordinary shares outstanding. What is the earnings after tax and interest? Earnings after tax and interest from the question there, 2022, the net profit after tax and interest is 1,115,000. Is that correct? Yes. How about the number of shares? The number of shares we check from the balance sheet. The capital, ordinary share capital, we can see that the par value is 10 shillings and the total amount is 1 million. 1 million. Therefore, the number of shares will be equal to the 1 million. 1 million divided by 10 shillings. That will give us the number of shares. We divide the total value by the par value. This is 1 million. So we divide, the number of shares will be 100,000. So we have 105 divided by 100. So the earnings per share, the year 2022, is equal to shillings 11 and 15 cents. 11 shillings and 15 cents for the year 2022. For the year 2023, we get the earnings after tax 1040. 1040 earnings after tax. We divide by the number of shares. To calculate the number of shares, we divide the total value of the ordinary share capital by the par value, which is the same as this one here. 100,000 is the number of shares. 100,000 is the number of shares. So we divide 1040 divide by 100. So this will be 10 shillings and 40 cents. 10 shillings and 40 cents. That is the earnings per share. Earnings per share. So every share earns 10 shillings and 40 cents the year 2023, 11 shillings and 15 cents for the year 2022. So that is the solution to the question that was tested in December 2023. This is the last question. We began by outlining the reasons why it is necessary to make adjustments to the accounts at the end of the accounting period. We gave one reason, the matching principle, the accrual accounting, revenue recognition, expense recognition, accurate financial reporting, compliance with accounting standards, then tax compliance. We've gone ahead to calculate 7 ratios. The first one is the current ratio. The formula for current ratio is current assets over current liabilities. And the ratio for 2022 is 2.3 times. This one is 3.6 times. The first two are liquidity ratios. This one is more liquid because you are removing inventory from current assets. So the company can pay the liabilities from more liquid assets for the year 2022 1.2 times, 1.6 times. The third ratio is an activity ratio, which is the average trade receivables collection period, which is calculated by dividing the average debtors over the annual credit sales times 365 days. For the year 2022, the collection period is 51 days. For 2023, 49 days. For the gross profit margin, this is a profitability ratio. It's calculated by dividing gross profit over sales. Gross profit over sales. For the year 2022, the gross profit margin is 50%. That means that out of 100 shillings made, out of 100 shillings sales, 50 shillings is a gross profit for the year 2022. For the year 2023, out of 100 shillings sale, 44 is the gross profit, 44 shillings. Out of 100 sales, shilling sales, 44 is the gross profit. The fifth ratio is the interest cover. Interest cover is calculated by dividing the operating profit, which is also known as the earnings before interest and tax, divided by the interest charges. So for the year 2022, the interest cover is 35 times. That means that EBIT is 35 times stronger than the interest charges for the year 2022 and 23 times stronger in the year 2023. The fifth ratio is the return on capital employed. The return on capital employed is calculated by dividing the EBIT over capital employed, that is the earnings before interest and tax over capital employed, or operating profit over capital employed. For the year 2022, the return on capital employed is 81%. For the year 2023, the return on capital employed 48%. Then lastly, we have calculated the earnings per share. The earnings per share is calculated by dividing the earnings after tax and interest over the number of outstanding ordinary shares, number of ordinary shares outstanding. And how do we calculate the number of ordinary shares outstanding? We take the total amount of ordinary share capital divided by the par value, the par value of a share. For the year 2022, the earnings per share is 11 shillings and 15 cents. That means that for every share held in a company, the shareholder is entitled to 11 shillings and 15 cents in the year 2022 and 10 shillings and 40 cents in the year 2023. That will mark the end of the revision session, where we answered question 5, which is the last question. Now, candidates, I urge you to check our books. This is the revision partner. We have answered all questions that were tested in the previous sittings. We've provided the solutions in this book, topically arranged. We have a session for all the questions in topically arranged, organized. Then the answers are presented at the back of the book. That will ease your revision. When you are revising, revise topically. After doing the topic, make sure you go back to the questions, answer the questions. We've also provided these answers in video format. I will, if you check our website, www.manifestedpublishers.com, we've answered all past paper questions in video format. So if you have any question, feel free to send in your questions. Below this video, there is a comment section where you can send your questions. We have sufficient resources for you to be able to gain the skills that you require, and also to gain the knowledge and expertise that is required in answering exam questions. Thank you for attending the lesson. God bless you. Bye-bye. Hello and welcome back to the lesson. Today we are going to answer question number 3, Advanced Auditing and Assurance, December 2023. We've done question 1 and 2. Today we are going to do question 3. In our next session, we'll do question 4 and 5. Question 3 reads as follows. CompuMax Limited is one of your audit clients for the year ended 30th June 2023. The company has followed generally accepted accounting principles and had a conservative approach to recognize revenue from its software application sales. Revenue was recognized only when the product was delivered to the customer. Due to increased competition leading to a decline in market share, the CEO of the company has put pressure on the Chief Finance Officer to find ways to improve the company's financial performance and boost revenue numbers. In reacting to the pressure, the CFO decided that the new policy will be that revenue from software application sales could be recognized as soon as the contract was signed, regardless of the product's actual delivery to the customer. The CFO did not disclose the change in policy. With the new policy, the company started to recognize revenue from software application sales immediately after contract signing, artificially inflating the company's revenue figures. This allowed the company to present a more favorable financial status, potentially increasing the share price and attracting new investors. Required, with reference to the above scenario, describe 3 circumstances under which a change in accounting policy is permissible. Roman 2, summarize 3 disclosures that could be made in the financial statements regarding the change in accounting policy. Roman 3, discuss 5 audit procedures that are necessary where an entity has changed an accounting policy. We're first going to answer part A, circumstances under which a change in accounting policy is permissible. We've read here that the accountant changed the accounting policy, but that was not disclosed. All right. The CEO did not disclose the change in the policy. So what are the circumstances under which a change in accounting policy is permissible? One circumstance is to comply with the change in new standards or interpretations. So a policy may be changed if there is any new standard or interpretation which a company needs to comply with. So we can say compliance with new regulations or standard, new accounting standard or interpretation. If there is any new interpretation to the accounting standards, or if there is any new accounting standard. So if there is new accounting standard or interpretation, then the company may change an accounting policy in order to do what? To comply with the new accounting standard. Compliance with a new standard or interpretation. Now, if a new accounting standard or interpretation is issued, a change in policy may be necessary to adhere to the updated accounting principles. 2, improved presentation. This may also necessitate change in the accounting policy. Improved presentation of financial performance. This is a circumstance that can necessitate change in accounting policy. Improved presentation of financial performance. If the current policy is considered misleading or unreliable in representing the financial performance of the company, then a change can be made for improved financial performance of the company. A change can be made for improved financial statement presentation. The third point is correction of error. This is yet another circumstance that necessitates change in accounting policy. If a past policy was applied incorrectly, resulting in misstated financial statements, then a change is required to correct the error and also present accurate financial information. So these are three circumstances under which a change in accounting policy is permissible. 3 marks. 1, 2, 3. 3 marks. Roman 2. Summarize 3 disclosures that could be made in the financial statements regarding the change in accounting policy. Disclosures that could be made. Roman 2. Disclosures that should be made or could be made in financial statements regarding change in accounting policy. What are the disclosures? One is nature of the change. One is to disclose the nature of the change. This is required to be disclosed in the financial statements. Nature of the change. Clearly explain the specific accounting policy that has been changed and the nature of the new policy being adopted. That means clearly disclose the old policy and the new policy. Clearly explain the specific accounting policy that has been changed. That is the old policy. And also the nature of the new policy being adopted. The second disclosure is justification of the change. What are the reasons for the change? Justify. Provide rationale for the change, explaining how it improves the presentation of financial performance, and also you ought to provide more relevant information to users. Why is the change being made? That's obvious, is it not? Then what is the financial impact of the change? If there's a change in accounting policy, for example, the policy on depreciation, what will be the impact of such change on the financial statements? In disclosing, the accountant ought to quantify the financial impact of the change on current and future periods, including income, expenses, the assets, including liabilities, and so on. What is the impact of this change on assets, liabilities, and expenses? And that may involve comparative statements showing the effect of both policies. So candidates were to give 3 disclosures that could be made in the financial statements regarding the change in the accounting policy. 3 marks. 1, 2, 3. 1, 2, 3 marks. We are moving on to answer part Roman 3. Discuss 5 audit procedures that are necessary where an entity has changed an accounting policy. Now, if a company changes an accounting policy, what audit procedures should you perform as an auditor? That's what we want to discuss. Audit procedures that are necessary where an entity has changed an accounting policy. Audit procedures that are necessary. Audit procedures that are necessary for policy change. The first procedure is review of documentation. Review of documentation. The auditor ought to examine the official policy statements, the board minutes, the management memos in order to understand the rationale and the decision-making process behind the change. You understand? Review of documentation surrounding the policy change. Another procedure is to reassess the accounting records. Reassessment of the accounting records. This may include recalculation of financial statements under both the old and the new policies to assess the materiality of the change and to ensure proper application of the new policy. So the auditor may compute, for example, if there's a change in the depreciation policy, the auditor may calculate the net income of the company under the old policy and the new policy, then compare the two to find out if there is any material difference as a result of the change. Reassessment of accounting records. It may include recalculating the financial statements, items, and so on. Testing of internal controls is another audit procedure. Testing of internal controls. Testing of internal controls. The auditor ought to evaluate the effectiveness of internal controls over new revenue recognition procedures to determine the risk of errors or intentional misstatements. 4. The fourth audit procedure is to do what we call independent verification. Independent verification. The auditor should confirm the existence and also the validity of contracts claimed as basis for revenue recognition before signing. You understand? The auditor can also perform analytical procedures to identify unusual patterns or inconsistencies in revenue trends. This may include the calculation of ratios and so on, analytical procedures. Disclosure. This is another procedure in relation to disclosure. We can call it disclosure evaluation. Evaluation of disclosure in relation to the policy change. Assess the adequacy and the completeness of disclosures made regarding the policy change in the financial statements and notes. So these are 5 audit procedures. 5 audit procedures, 10 marks. 1 is review of documentation. 2, reassessment of accounting records. 3, testing of internal controls. 4, independent verification. 5, disclosure evaluation. So candidates, by carrying out these audit procedures, the auditor can ensure that the change in accounting policy is justified, it is properly applied, and also adequately disclosed, upholding the integrity and the reliability of the financial statements. You understand? So that is what ought to have, what the auditor ought to do, because remember, this question is being set on the from the background of the scenario that has been provided, and this analysis candidates helps or highlights the ethical concerns surrounding this company, CompuMax Limited, change in the revenue recognition policy, and also the crucial role of the auditor in identifying and addressing such instances to maintain a fair presentation of financial statements. You recall that the company has been following generally accepted accounting principles and had a conservative approach to recognition of revenue. And here we read that revenue was recognized only when the product was delivered to the customer. But there has been increased competition leading to declining market share, and the CEO has put pressure on the chief finance officer to find ways to improve the company's financial performance and boost revenue numbers. So what does the CFO do? The CFO decided that that he should change the policy for revenue recognition, where sales would be recognized as soon as the contract was signed, regardless of the product's actual delivery to the customer. So, and the CEO did not disclose the change in policy. That's why I said that this analysis highlights the ethical concerns surrounding CompuMax change in revenue recognition. The CFO did not disclose the change in policy. And we read that with the new policy, the company started recognizing revenue from software application sales immediately after contract signing, artificially inflating the company's revenue figures. Artificially inflating the company revenue figures. So that's why, as an auditor, additional audit procedures ought to be carried out, and we've highlighted 5 such audit procedures. Now that is part A of the question. Part B of the question reads, the question on whether a change constitutes a change in policy or change in estimate has been a major source of discussion among accountants and auditors. Distinguish between change in accounting estimate and a change in accounting policy. We are going to have the distinction in form of a table. First column will be basis for distinction. Then you'll have change in accounting estimate. Now, candidates, when faced with a question that requires you to distinguish between two things, is advisable that you have the distinction in form of a table for easy presentation, better presentation. So we are going to distinguish between change in accounting estimate and change in accounting policy. Right? The difference, candidates, between change in accounting estimate and change in accounting policy can be, we've read from the question, it has been a basis for discussion. It's been a major source of discussion among accountants and auditors. So what's the difference between change in accounting estimate and change in accounting policy. Sometimes, candidates, you can distinguish phrases or terms based on definition. What does change in accounting estimate entail? Now, change in accounting estimates adjusts the carrying amount of an asset or liability. This one adjusts the carrying amount of an asset or liability. Change in accounting estimate adjusts the carrying amount of an asset or liability or related expense. You understand? Let me say, or related expense. And this change is based on, could be based on updated information or reassessment of future benefits or obligations associated with that item. And an example is revising the estimated useful life of an asset based on its current condition or industry trends. So if an asset was estimated to have a useful economic life of, say, 10 years, the company may decide to change that estimate of 10 years to, say, 5 years. And that may be as a result of new information. That may be as a result of the current condition or industry trends regarding that estimate. So that is the meaning or what change in accounting estimate entails. It entails adjusting the carrying amount of an asset or liability or related expense. I've given an example of adjusting the estimated economic life of an asset, because that's an estimate. When you say that an asset is likely to have an economic life of 15 years, that's an estimate. So that estimate can be changed depending on the current condition of the asset. Now, change in accounting policy fundamentally alters how a specific type of transaction, event, or condition is accounted for in the financial statements. Alters how a specific type of transaction, this one alters how a specific type of transaction, it could be a transaction or even event or condition, event or condition is accounted for. Change in accounting policy alters how a specific type of transaction, event, or condition is accounted for in the financial statements. An example could be switching from the straight line method of depreciation to, say, the accelerated depreciation method or the reducing balance method or any other method, because that is a policy on how. So that could be an example. So this one alters how specific type of transaction, event, or condition is accounted for in the financial statements. So that's the distinction between change in estimate and change in accounting policy based on the definition. So we have distinguish the two on the basis of their definition. You understand? Another basis for distinction could be application. Application. Now, generally, candidates, change in estimates are applied prospectively. Change in an accounting estimates is applied prospectively, generally. Change in accounting estimates are applied prospectively. What does that mean? That means that such a change has an impact on the future periods only, and the existing financial statements remain unchanged. Existing financial statements remain unchanged. Change in accounting estimates only affects future periods. How about change in accounting policy? Now, here, the change is applied retrospectively. It is applied retrospectively. Applied retrospectively. The change is applied. Change in accounting policy is applied retrospectively. This one goes back to prior periods. All right? It restates prior financial statements to reflect the new policy. It does what? Restates prior financial statements. Restating prior financial statements to reflect the change in the accounting policy. This one looks to the future, and the existing financial statements remain unchanged. That is the second distinction. You understand? This is the second distinction based on application. The third one is based on justification. Justification or the rationale for change. The change in accounting estimates is made when new information is available. Availability of new information. New information becomes available, or existing estimates prove inaccurate. Where where the existing estimates prove inaccurate, then that necessitates change in accounting estimate. You understand? Where the current estimate leads to inaccurate financial statements, then there is justification or rationale for change. That's the rationale. But for change in accounting policy, the rationale for change in accounting policy is to improve comparability and consistency. You have to give how many distinctions? These are 4. I've given you 3. You have to give 2. I've given you 3. Now, for change in accounting policy candidates is to improve comparability, to improve consistency, and what we call representational faithfulness. Representation of faithfulness of the financial statements, because as we know, one key qualitative feature of financial statements is faithful representation. So it may be necessary to change accounting policy, the rationale being to improve comparability, consistency, and representational faithfulness of the financial statements. That's why this change is applied retrospectively, so that there is consistency. If a company chooses to change, for example, the depreciation policy on depreciation in 2023, the company may be required to adjust prior financial statements to reflect the new change, so that there could be comparability, consistency, and representational faithfulness of the financial statements. So that's it for question 3. We've answered part A, which had Roman 1, 3 marks, Roman 2, 3 marks. Then there is Roman 3, how many marks? Roman 3, these are 10 marks. Then there is part B of the question, distinguish between change in accounting estimates and change in accounting policy. We've distinguished the two based on definition, 1 mark, 1 mark. Application, change based on application, 1 mark, 1 mark. Then we have made another distinction based on justification or rationale for change. This is 1 mark, 1 mark. So any two distinction or differences here would earn the candidate 4 marks. Any 2 points here would earn you 4 marks. Another justification could be disclosure. So there are many differences. Disclosure. And both needs disclosure, but the extent of disclosure is dependent on the extent of the change. So these are 20 marks. We've answered question 3, December 2023, Advanced Auditing and Assurance, that was done by the CPA Advanced Level candidates. Thank you for attending the lesson. I'm going to answer this 4th question in our subsequent lesson, next lesson. But before you attend the lesson, please do the question on your own, so that when you are answering the question here on the board, we compare notes. That's the best way to revise. Bye-bye. Welcome to the lesson. We're going to answer April 2024 Advanced Financial Management paper. Question 2A reads, 2 assets, A and B, are known to lie on the security market line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. You are considering the foreign securities which are available in the market. You have security A, B, C, D, E with expected returns and betas provided. required, determine the risk-free rate of return. Determine the risk-free rate of return. That is Roman 1. Determine the risk-free rate return. Now, candidates, in the context of this question, you can see we have asset A has a beta of 0.5 and a risk-free rate of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. Now, before we get the risk-free rate, what is beta? What is the meaning of beta? Beta. Now, beta measures the sensitivity of an asset's returns to the overall market's returns. That is to say that beta indicates how much an asset's price is expected to move in relation to the market movements. And by now I know you know that beta of 1 indicates that the price is moving in tandem with the market. That is beta that is equal to 1. Because remember, I've just said that beta measures the sensitivity of an asset's returns to the overall market. So if you have a beta of 1, that means that the asset's price is moving in tandem. It is moving at the same rate with the market. But you may have beta being greater than 1, like is the case here with the asset B. Asset B's beta is 1.75. So this 1.75 is greater than 1. What does that mean? Now, when you have an asset beta that is greater than 1, that tells you that the asset is more volatile than the market, and its price will move more than the market. The price will move more than the market. That tells you that that price is more volatile if it is greater than 1. You may also have an asset beta that is less than 1, like the one in asset A. Asset A has a beta of 0.5. 0.5 is less than 1. Now, this asset is less volatile than the market. That is to mean that for every 1% change in the market, asset A's return is expected to change by 0.5%. Is expected to change by 0.5%. And we've seen that asset B's beta is 1.75. Is 1.75, which is greater than 1. Asset B, I indicated, is more volatile than the market, meaning that for every 1% change in the market, asset B's return is expected to change by 1.75%. But we also read that these two assets lie on the same security line market. The two assets A and B are known to lie on the security market line. They both lie on the security market line. So what is a security market line? Now, a security market line is a graphical representation of the CAPM, which helps investors understand the relationship between risk and return for different assets. So asset A and B, all right, two assets A and B lie on the security market line. What does that mean? Now, since both assets lie on the security market line, their expected returns are directly proportional to their betas. That is what it entails. They are directly proportional to their betas. It is important for you to have that small knowledge, beta, because we have a column there for beta. Now let's now work out the risk-free rate of return. The risk-free rate of return. I'll begin on page 1. This is April 2024, question 2A, Roman 1. We are to calculate the risk-free rate of return. The risk-free rate of return given the information. In the first sentence, we have asset B has an expected rate of return of 20% and a beta of 1.75. Then in the same question, the expected rate of return is 20%. Expected rate of return is 20% and the beta is 1.75. So, how do we determine the risk-free rate? Which formula are we going to use? We are going to use the CAPM formula. Expected rate of return is equal to risk-free rate plus the premium. The premium is RM minus RF times beta. And we are going to use the beta for asset B because that is the information we have. Asset B, we have the beta of 1.75. The expected return is 20%. We do not know the risk-free rate. How about the risk-free rate? We do not have it, but we have the beta of 1.75. 1.75 is the beta. Okay. Then what other information do we have? Asset A has a beta of 0.5 and a risk premium. So we have the risk premium. Return on the market minus risk-free, that is the risk premium. So we have the risk premium of 4%. That clear? The risk premium, we have it. And therefore, this should be equal to, this is equal to. So you see, risk-free rate is the unknown, and we are going to calculate it. This is 20% risk-free rate plus 4% times 1.75. How much is it? Kevin says 7%. Is it 7%? 7%. 4% times 1.75, is it 7%? Muhammad Hassan says 0.07, convert it into percentage, that will be 7%. So you can see here candidates risk-free rate will be 13%. It's 20% minus 7%. 13%. Is that true? 13% is the risk-free rate. Kabasha, welcome. Then we are required to calculate the required rate of return. The required rate of return. There was a problem with the setting of the question here because that Roman 1 ought to have been part of what we have answered. Before you come to, you are considering the following securities which are available in the market. Roman 1, we are to calculate the risk-free rate. Roman 2 is independent of Roman 1. Roman 1, we were to determine the risk-free rate given the data before the table, the data before the securities shown in the table. Two securities A and B are known to lie on the security market line, are known to lie on the market security line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.7. The risk-free rate that we have computed in Roman 1, we're going to use it in determining the required rate of each security in Roman 2. Okay, so we need to make that correction in the question. The question was misplaced. Roman 1 was required to be inserted before the table. In Roman 2, we are to calculate the required rate of return. The required rate of return. Roman 2, required rate of return. Now, the required rate of return, we still use CAPM to calculate the required rate of return, which is equal to risk-free rate plus market return minus risk-free rate times the beta. And we'll calculate for each security. We have a column for the security A, B, C, D, and E. The E. Okay, so that's the first column. Then, are we together? Hannah, we are answering April 2024. So for security A, the risk-free rate is 13%, and that will be constant for all the securities. 13%. We add the premium. Market return minus risk-free is the premium. The premium is also 4% for all the securities, then we multiply by the beta for security A. The beta for security A is 2. That will give us the required rate of return. How much is it? For B, it will be 13 plus 4 times the beta of 0.75. C, 13% plus 4. The beta there is 1.25. D, 13% plus 4, beta negative 0.25. E, 13% plus 4, the beta there is 3.25. So these are the required rate of returns for each security. So can I have the answers? Kevin says 21. It's 21%. These are percentages. B, 16%. 16%. Security C, is it 18? Kevin says 18%. Security D, Kevin says 12%. The last security, 26. Required rate of return, 26. So that's it. How many marks? How many marks? 4 marks. 4 marks. That's 4 marks. 1, 2, 3, 4, 5. 4 marks. This was how many marks? 2 marks. 1, 2, 2 marks. Now let's answer the second part. This second or third. Identify which security is undervalued, overvalued, or correctly valued. Now to calculate or to determine or identify which security is undervalued, overvalued, or correctly valued, we are going to compare the required rate of return and the expected return. So we're going to have another table for, this is 3. We have a table for security A, B, C, D, E. Then from the information given, we have expected return. We have a column for expected return. A, 20%, B, 14%, C, 15%, D, 12%, E, 31%. This you are going to compare with the required rate of return. Required return that we've got determined here is 21, 16, 18, 12, and 26. So to determine whether a security is overvalued, undervalued, or correctly valued, we compare the required return against the expected return. Now someone tell me, is security A overvalued, undervalued, or correctly valued? Roger says undervalued, undervalued, undervalued. Roger says undervalued. Any other attempt? Anna says overvalued. It is above the expected. So it is overvalued, correct. Overvalued. Security A is overvalued. Now, candidates, you need to understand that expected return is the return an investor anticipates earning from a security. And required rate of return is the minimum return an investor expects to compensate for the risk of investing in the security. So when the expected return is higher, let me begin with that. When the expected return is higher than the required rate of return, it means the security is potentially offering more return than investors demand for its level of risk. And that suggests the security is undervalued. And it might be a good investment opportunity. But in this case, in the first case, the expected, in our case here, the expected return is lower. This expected return is lower than the required rate of return. That indicates that the security is not meeting investor expectations for its level of risk. It is therefore considered overvalued. And investors might be less inclined to invest in it unless the price drops. So security A is overvalued. Now with that knowledge, what do you think of security B? Is it overvalued or undervalued, security B? If security A is overvalued, what of security B? I've seen many candidates confusing. That's why I'm taking time to explain, so that you don't just memorize, but you should have the understanding. Why is it overvalued? I've explained why it is overvalued and the implication of overvaluing it. B is overvalued. That is what Jackie says. Overvalued. Jackie says overvalued. That is correct. Security C. Overvalued. Security D. B is overvalued. D. 12. This one is correctly valued. Correctly valued. Correctly valued. Then the last one is definitely undervalued. Undervalued. It is undervalued. So that would earn you just 2 marks. 2 marks. 1, 2, 3, 4, 5, 2 marks. Greetings you all and welcome to the lesson. I am back to continue with the study of the chapter in advanced taxation known as tax systems and policies. Today we'll be winding up the chapter. So far we've covered the first subtopic, which is types of tax systems. In our first lesson we studied the types of tax systems. In the second lesson we explained the role of taxation in economic development. We also looked at the how to expand the tax base of a tax system, expansion of tax base. We also covered efficiency in the tax systems. We studied what it entails, how to put in place measures to ensure that the tax system is efficient. Then we highlighted or outlined the design of a tax policy. We explained how a tax policy can be designed. We gave the different stages in the process of designing a tax policy. In the fourth subtopic, we covered criteria for evaluation of tax system. We studied how to evaluate a tax system. Then in our last session, we took time to highlight the various tax reforms that have taken place in Kenya under various acts of parliament. Then we highlighted the modernization of the initiatives that the Kenya Revenue Authority has taken in the process of modernizing the tax system. In today's lesson, our attention will be on the KRA structure with the focus on the large taxpayer and the medium taxpayer organizations. We know that the Kenya Revenue Authority has a structured organizational framework that divides taxpayers into two main categories: the large taxpayers and the medium taxpayers. The large taxpayers and the medium taxpayers. And this categorization allows for tailored service. Allows for what? Allows for tailored services that KRA advances or gives to the taxpayers. It allows for tailored service delivery and efficient tax administration based on the specific needs, based on the specific complexities of each large or each segment, all right? Or each segment, taxpayer segment. There are two segments. That's what we are going to study today. And in studying the two segments, we're going to look at the key functions of the large tax payers organizations and also the medium tax payers organizations. So the Kenya Revenue Authority, I've said, has a structure that categorizes taxpayers. All right? It divides taxpayers into two main categories: the large taxpayers and the medium taxpayers. So let's first of all begin with the large taxpayers. Large taxpayer office. So KRA has an office known as large taxpayers office. The large taxpayers office. The large taxpayers office, candidates, is the office within KRA that is responsible for maintaining the tax affairs of large corporations, including multinationals These are multi It's an office that provides services to multinationals, to listed companies. Okay, these are large corporations or any other entity with significant revenue or turnover. Multinationals, listed companies, and any other listed company or any other organizations with the large turnover or revenues, significant revenues. So the office, the large taxpayer office, offers what we call dedicated services. It offers expertise to these taxpayers, ensuring that their tax obligations are met effectively and efficiently. So let's look at the key functions of this office. What are the key functions of the large taxpayer office? What are the key functions of the large taxpayer function? What are the key functions of the large taxpayer office? The large taxpayer office. The first one is to do with the risk assessment. Tax risk assessment and management. Tax risk assessment and management. This involves conducting in-depth risk assessments to identify and mitigate tax risks associated with the large taxpayers. Another key function, tax audits. Tax audits. Related to audits, we have investigations. Tax audits and investigations. Tax audits and investigations. This involves conducting comprehensive audits and investigations of large taxpayers to ensure compliance with tax laws, to ensure compliance with regulations. 3, transfer pricing analysis. This is another function of the large taxpayer office, transfer pricing analysis. This involves analyzing transfer pricing arrangements between related party entities within multinational corporations to ensure adherence to international tax principles. Tax transfer pricing analysis. 4, tax planning and advisory. Now, tax planning and advisory services entails providing tax planning and advisory services to the large taxpayers in order to help them optimize their tax positions and manage their tax liabilities effectively. So these are the key functions of the large taxpayers office within the Kenya Revenue Authority structure. Then let's study the medium taxpayers office. Medium taxpayers office. Medium taxpayers office. Medium taxpayers office. Now, the medium taxpayers office serves the medium-sized businesses. It serves the medium-sized medium sized entities. The large taxpayers office serves large multinationals and listed companies and any other entity that has significant turnover or significant revenue. The medium-term taxpayer, the medium taxpayers office, on the other hand, serves medium-sized entities. It serves the medium-sized entities or businesses with a moderate level of revenue or turnover. Moderate with moderate turnover or revenue. Moderate turnover or revenue. So the medium taxpayers office provides a range of services to support these taxpayers, these medium-sized entities, so that they can comply with tax laws, so that they can meet their tax obligations, and so that they can manage their tax matters effectively. So what are the key functions of this office? What are the key functions of the medium taxpayers office? The first function is tax registration and compliance. Tax registration and compliance is the first key function of the medium taxpayers office. This involves facilitating tax registration, tax filing, and also tax payment processes for medium taxpayers. 2, tax education and awareness. Tax education and awareness. This means providing tax education and awareness programs to medium taxpayers to enhance their understanding of tax laws, to understand the understanding of tax regulations. The third key function of medium taxpayers office is tax audit and investigations. Tax audits and investigations. Conducting tax audits and investigations of the medium taxpayers organizations when necessary, and also to ensure compliance with tax laws. 4, tax dispute resolution. Tax dispute resolution. This means assisting medium taxpayers in resolving tax disputes with the Kenya Revenue Authority through mediation and through other dispute resolution mechanisms. So these are 4 key functions of the medium taxpayers office. We've identified 4 functions of the large taxpayers office. So candidates, this is in brief the KRA structure with special reference to the 2 offices, the large taxpayers office and the medium taxpayers office. These are dedicated offices for the large taxpayers and medium taxpayers, which reflects the recognition that different taxpayer segments have unique needs and require specialized expertise. And this is an approach taken by KRA that aims to enhance the efficiency and the effectiveness of tax administration ensuring that all taxpayers receive the support they need to comply with tax laws and to contribute to Kenya's revenue base. So with that, we come to the end of this lesson. I'm going to give you today's division questions. Number 1, compare and contrast the functions and responsibilities of large taxpayer and medium taxpayer organizations within the KRA structure. How do they contribute differently to tax administration? Number 2, discuss the challenges faced by large taxpayer organizations in managing compliance and tax collection compared to medium taxpayer organizations. Number 3, how does the structure and operation of these taxpayer organizations impact the efficiency and effectiveness of taxpayer administration in Kenya? Number 4, explain the strategies employed by tax authorities in managing and balancing the needs of large and medium taxpayers, ensuring fair treatment and compliance across both groups. These are 4 revision questions. Ensure you attempt the questions. I hope to meet you in the next session and continue sharing knowledge in taxation. Bye-bye. Hello and welcome back to the lesson. Today we're going to study authority, power, and influence in the context of public administration. Now, administrative theory candidates encompasses various concepts and frameworks that guide the effective functioning of organizations. And among such concepts are authority, power, and influence, which are central to understanding how decisions are made, to understand how decisions are implemented. In this lesson, we just do an overview of authority, power, and influence. So by the end of this lesson, you should be able to explain the meaning of authority, power, and influence. We begin with authority. What is authority? Authority refers to the legitimate right to make decisions, legitimate right to issue orders, and also to allocate resources within an organization. Authority, I repeat, refers to the legitimate right to make decisions. Legitimate right refers to the right to make decisions, the right to issue orders, and the right to allocate resources. So if there is one person in an organization who makes decisions or issues orders or allocates resources, then that person can be said to be having authority. And it is conferred by a formal position. It is done what? It is conferred on a formal position. For example, an accountant may have the legitimate right to spend money within an organization. Okay? That's an example. A human resource manager may have the legitimate right or the authority to advertise for a vacancy in an organization. A procurement officer may have the authority in an organization to purchase items within an organization. So authority is conferred on a formal position. I've given an example of a position of an accountant, a position of a procurement officer, and a position of a human resource manager. And there are different types of authority. For example, we have the traditional authority, we have the charismatic authority, there is the the rational or legal authority, and so on. So what is the importance of authority in administration? Importance of authority in administration. One is decision making. Decision making. Authority ensures that decisions are made and enforced and that are enforced in a structured manner. Authority helps people understand how decisions are made. Authority ensures that decisions are predictable, and it ensures that decisions are made and enforced in a structured and in a predictable manner. The second reason why authority is important is in relation to coordination. 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 Authority facilitates coordination by clearly defining who has the right to make specific decisions. For example, in an organization, we may have an accountant, we may have a human resource manager, we may have another position. So each and every formal position has its own level of authority, and that makes it easy to coordinate the efforts and the decisions that are made by different authorities within an organization. Accountability. Number 3, accountability. Accountability. Authority establishes a clear line of accountability as individuals in positions of authority are responsible for their decisions, because it is known who makes the purchases, who hires, who tenders. So that makes it easy to hold individuals accountable for their decisions, such that if an accountant spent money in purchasing items that were not meant to be spent, then such an accountant can be held accountable. That decision cannot, the accountability may not be expected from a different position. So it helps members of an organization to be accountable. Accountability. The second concept, power. Power. We have defined authority as the right to make decisions, issue orders, and allocate resources. How about power? Now, power, on the other hand, is the ability to influence or control the behavior of others. Power is the ability to influence, the ability to influence or control the behavior of others. Power is the ability to influence or control the behavior of others, and power may go beyond the confines of authority. It is exercised through various means and can come from different sources, like legitimate power is a source which is derived from formal position or a role within an organization. Another source of power is reward power, which is based on the ability to provide rewards and incentives to others. If one has the ability to provide incentives, then such a person can influence or control the behavior of others, because people are motivated by incentives. Another source of power is coercive power. Now, based on the ability to punish or to provide rewards, or based on the ability to punish or let me say to punish or impose negative consequences, based on that, to that extent, individuals can be seen as being powerful. If an individual can punish, if an individual can impose negative consequences, then that is what we are referring to as coercive power. Another source of power is reverent power, which is based on personal traits or relationship that inspire loyalty, that inspire admiration, and so on. So those are 4 sources of power. In fact, 5. Legitimate power, reward power, coercive power, expert power. We may also have reverent power. Now, expert power is derived from possessing specialized knowledge or expertise. A person who has expert power is one who has knowledge that others do not have. If you have knowledge that others do not have, then you have expert power, and that is a source of power. So power is the ability to influence or control the behavior of others. An expert can control the behavior of others. An expert can influence the behavior of others. So power is the ability to influence or to control the behavior of others. You understand? Yes, you do. So what is the importance of power in the context of public administration? Importance of power. One is influence and control. Influence and control. Influence and control. Power enables leaders to influence the actions and attitudes of subordinates. Power helps the supervisors to influence and control subordinates. Power, the ability to influence. 2, conflict resolution. Effective use of power can help resolve conflicts and maintain harmony within an organization. It is important in conflict resolution. 3, motivation. Motivation. Now, different forms of power can be used to motivate. They can be used to enhance productivity and so on. Employees can be motivated through different forms of power, like expert power. Expert can motivate employees. Coercive power can also motivate when you know that you may be punished for your actions by your superior, then that can motivate you to work towards excellence. So these are 3 reasons why power is important in the context of public administration. The last aspect, influence. Influence is the 3rd concept we are going to learn in today's lesson. Influence. What is influence? Now, influence is the ability to affect the behavior of others. Influence is the ability to affect the behavior, to affect the attitudes and opinions of others. It is the ability to affect the attitudes, opinions. It is the ability to affect the attitudes, the ability to affect the actions, the ability to affect the behavior of others and behavior of others. If a person can influence your attitude, if a person can affect your opinion, if a person can make you change your behavior, then such a person has influence over you. And it often involves persuasion. Influence involves negotiation. It involves building relationships and so on. So influence is the ability to affect the attitudes, the behavior, and opinions of others. And I've said there are various techniques that can be used to influence others. techniques. Persuasion. 1. Persuasion. One can affect your attitude, opinions, or behavior through persuasion. That means using logical arguments, using facts, and emotional appeals to convince others. Another technique is negotiation. Negotiation is a technique that can be used to affect the attitudes, opinions, and behavior of others. Negotiation. Engaging, that means engaging in dialogue to reach a mutually beneficial agreement. Negotiation can affect attitudes, opinions, and behavior of others. Then building alliances. Building alliances. That is to say, forming coalitions, forming partnerships, forming networks in order to strengthen one's position and also to achieve objectives. So these are 3 techniques that one can use to influence the attitudes, opinions, and behavior of others. So that is the end of the lesson. We have briefly discussed 3 important concepts in public administration: authority, power, and influence. Authority, power, and influence. Assignment 1. Differentiate between the concepts of authority, power, and influence in public administration. How are they exercised, and what are the sources of each? 2. Discuss the challenges faced by public administrators in balancing their professional expertise with political considerations. How can they navigate these tensions effectively? 3. What are the different leadership styles observed in public administration? Which styles are most effective in different contexts and why? 4. Explain the concept of organizational culture in public agencies. Explain, I repeat, the concept of organizational culture in public agencies. How does it influence the behavior and decision-making of public servants? Thank you for attending the lesson. In our next session, we are going to study the relationship between public administration and politics. Bye. Greetings and welcome back to the lesson. Today we are going to begin on a new topic under the Advanced Public Financial Management subject. The topic is called Management of Public Debts in both national and county governments. This topic has 5 subtopics. Number 1, Introduction to Public Debt and Debt Instruments. Number 2, Establishment, Functions of Public Debt Office. Number 3, Debt Management in the County Government. Number 4, Global Best Practices in Management of Public Debts. Number 5, Key Stakeholder and their roles in public debt management, including the National Treasury and Parliament, that is key stakeholders. The number 6, Power of national government to lend money and management of guarantees. Today we'll do the introduction to public debt, and then we will outline the debt instruments. Now, candidates, public debt, also known as government debt, it can also be known as the public debt or the national debt, sometimes referred to as sovereign debt, is the total amount of debt owed at a point in time by government or county government. All right? So government debt or public debt can be owed to lenders within the country, or it can be owed to foreign lenders. That is the domestic debt and foreign debt. The debt that is owed to members within the country or bodies within the country, it could be the banks or individuals, any debt that the government owes persons within the country is known as the domestic debt. And any debt owed to persons outside the country is referred to as foreign debt or owed to foreign lenders. Now, the portion of the total debt which has a direct charge on government revenues is taken as public debt. And public debt is a measure of government indebtedness. It includes debts denominated in shillings as well as debt denominated in foreign currency. And candidates, as I have said, public debt comprises of domestic and external debt. And each type has its own benefits and drawbacks. That is the domestic debt and the external debt. The internal debt and the external debt each has got its own drawbacks, with trade-off between cost of borrowing and exposure to various types of risks that needs to be balanced in order to ensure ample and timely access to cost-effective funding. So candidates, domestic debt, we can say, is a charge on the budget and must be serviced through government revenues, or maybe additional borrowings, whereas the external debt is a charge on balance of payments and perhaps additional borrowings. Do you understand that? Domestic debt and B, external debt or foreign debt. I've just said the domestic debt is a charge on the budget. That means that the domestic debt has to be funded through the budget. Domestic debt is a charge on the budget and must be serviced through government revenues. It's prudent, candidates, when the government borrows internally, then the repayment of such debt should be through the revenues that the government obtains from taxes, internal. However, foreign debt or external debt, should be serviced through balance of payment. It's a charge on balance of payments and must be serviced from foreign exchange earnings. Domestic debt is serviced through government revenues, whereas foreign debt is serviced through foreign exchange earnings. It could be serviced through reserve drawdowns, or additional borrowing or borrowings. Now, these two, the domestic debt and the foreign debt, should be managed separately. Why? In order to ensure what we call fiscal and external account solvency. This one should be managed properly or prudently or separately so that the government can maintain fiscal account solvency. internally. The foreign debt should be managed separately so as to achieve the external account solvency. Okay. Now let's proceed and outline public debt instruments. Public debt instruments. Public debt instruments. Types of public debt instruments. Now, the debt instruments are those instruments that require the payment of principal and interest, or both, at some points in the future. And all liabilities are considered debt, except liabilities in form of equity and investment, fund shares, and financial derivatives. Okay? Do you understand? First of all, I've said that debt instruments are those instruments that require the payment of principal and interest, or both at the same points of time in future. Debt. And all liabilities are considered to be debt, except liabilities in form of equity and investment fund shares, except financial derivatives, except employee stock options. And these instruments include special drawing rights, the SDRs, special drawing rights. Then we have what we call currency and deposits. This is another form of debt instruments, currency and deposit. Debt securities, obviously loans. Loan is a debt, type of a debt. Loans, we have pensions, insurance, and standard guaranteed schemes. Insurance, pensions, and standard guaranteed schemes. Other accounts payable. Other accounts payable. So what are these SDRs? SDRs, special drawing rights. Special drawing rights are international reserve assets created by the IMF and allocated to its members to supplement what we call reserve assets. SDRs represent each holder's unconditional right to obtain foreign exchange or other reserve assets from other International Monetary Fund members. So SDRs are assets with matching liabilities, but the assets represents claims on the participants collectively and not on the IMF. And candidates, a participant may sell some or all of its SDR holdings to another participant and then receive other reserve assets, particularly foreign exchange, in return. Participants may also use SDRs to meet liabilities. So special drawing rights candidates are international reserve assets, and these assets are created by the IMF and allocated to members of IMF. The purpose is to supplement reserve assets. and they represent each holder's unconditional right to obtain foreign exchange or other reserve assets from other participants. These are members of IMF. This is a type of public debt instrument. The second type is currency and deposits. Currency, we all know, consists of notes and coins that are of fixed nominal values and are issued or authorized by the central bank or by the government. And all sectors may hold currency as assets, but normally only the central bank or the government is able to issue currency under the authorization of the central bank or the government. And currency candidates constitutes a liability of the issuing units. And therefore, the unissued currency held by a public sector unit is not treated as a financial asset of the public sector or liability of the central bank. But gold and commemorative coins that are not in circulation as legal tender or as monetary gold are classified as non-financial assets rather than currency. So currency are just notes and coins. Now deposits, on the other hand, deposits are all claims represented by evidence of a deposit on the deposit-taking corporation, including the central bank, and in some cases, general government and other institutional units. So a deposit is usually a standard contract that is open to the public at large that allows the placement of a variable amount of money. So currency and deposits are also types of debt instruments. Then we have debt securities. What are debt securities? Debt securities are negotiable financial instruments serving as evidence of debt. The security normally specifies a schedule for interest payments and principal repayments. And examples of debt securities are things like bills, bonds, debentures, including bonds that are convertible into shares, commercial paper, negotiable certificates of deposits. We have loans that have become negotiable from one holder to another. That's also a form of a debt security. We have asset-backed securities, and also what we call the collateralized debt obligations. Bankers' acceptances are also debt securities, and other similar instruments normally traded in the financial markets. Debt financial market, debt securities. These are instruments that are traded in the financial market. There are many: asset-backed securities, collateralized debt obligations, non-participating preferred stocks or shares, and so on. Debt securities. Loans. Loans. A loan is a financial instrument that is created when a creditor lends funds directly to a debtor and receives non-negotiable documents as evidence of the asset. We may, in this category, have instruments like the overdrafts, bank overdrafts, mortgage loans, loans to finance trade, credit, and advances. We may have repurchase agreements, financial assets and liabilities created by financial leases. We may have claims or liabilities to the IMF in form of loans. Okay? So candidates, the trade, credit, and advances and similar accounts payable are not loans. That's why we have accounts payable here. These are not loans. And loans that have become marketable in the secondary markets should be reclassified under debt securities. However, if only traded occasionally, the loan is not reclassified under debt securities. So these are loans. Then 5, insurance, pensions, and standard guaranteed schemes. Now, these comprise the non-life insurance technical reserves, the life insurance and annuities entitlements. We have pension entitlements. This could also include what we call the claims of pension funds on pension managers. We also have entitlements to non-pension benefits, provision for calls under standardized guaranteed schemes, and so on. That's what constitutes insurance, pensions, and standard guaranteed schemes under public debt instruments. Then lastly, we have other accounts payable. Other accounts payable consists of trade credits and advances and miscellaneous other items due to be paid. All such liabilities should be valued at the amount the debtor is contractually obliged to pay the creditor to extinguish the obligation. So trade credit and advances include the trade credit extended directly to purchase goods and services. It may also include advances for work that is in progress or to be undertaken, such as progress payments made during construction or for prepayment of goods and services. So the trade credit extended by the seller of goods and services does not include loans, does not include debt securities, does not include other liabilities that are provided by a third party to finance trade. So if a government unit issues a promissory note or other security to consolidate the payment due on several trade credits, then the note or the security will be classified as a debt security. Do you understand? Trade credit extended by the seller of goods and services does not include loans, does not include debt securities or other liabilities that are provided by a third party. So these are types of public debt instruments. Special drawing rights, currency and deposits, debt securities, loans, insurance payments, insurance, pensions, and standard guaranteed schemes, and other accounts payables. Thank you for attending the lesson. I will see you in our next session where we continue to share knowledge in public finance. Thank you. Bye. Hello everyone, and welcome back to the revision of the Advanced Auditing and Assurance paper that was done in December 2023. We, in our last lesson, did question 1. Today, we move on to question number 2. Part A of this question reads, the following is an extract from a speech presented in a recent professional forum. First paragraph reads, in the private sector, going concern is an area of interest to users of financial statements. Shareholders and lenders wish to know that a business will continue into the foreseeable future before they can make investment or lending decisions. Paragraph 2. The going concern concept in the public sector differs from that in the private sector. This is because most public bodies, whether government departments, devolved administrations, local public bodies, or national funds, have a statutory existence that makes technical insolvency almost impossible. Lastly, the last paragraph, despite that, stakeholders in the public sector still have an interest in knowing whether these institutions are financially sustainable. Required, in the context of the above statement, discuss 8 factors that an auditor would consider in determining the going concern assumption of a public entity. So we've read that in the private sector, going concern is an area of interest to users of financial statements, and shareholders and lenders wish to know that a business will continue into the foreseeable future before they can make investment or lending decisions. The second paragraph says that the going concern concept in the public sector differs from that in the private sector. This is because most public bodies, whether government departments, devolved administrations, local public bodies, or even national funds, have a statutory existence that makes technical insolvency almost impossible. Despite that, shareholders or stakeholders in the public sector will still have an interest in knowing whether these institutions are financially sustainable. Required, in the context of the above statement, discuss 8 factors that an auditor would consider in determining the going concern assumption of a public entity. Now, candidates, while technical insolvency may be less likely in public entities, their going concern can still be impacted. So the question is, what are some of the factors that an auditor should consider when assessing the going concern assumption for public bodies? That is the question we are going to answer first. Part A. Factors that an auditor should consider in determining the going concern assumption. Now, the first factor to consider is government funding. The government funding reliance. Government funding reliance. What does that mean? That means that the entity's dependence on government funding and stability of such funding plays a key role. And significant funding cuts or uncertainties can threaten the ability to continue in operation. So when determining whether a public entity will continue operating in the foreseeable future, to determine the going concern assumption of a public entity, the auditor should check government funding reliance, such that if there is significant funding cuts for a given public entity or department, then that department is likely not to continue in operating in the foreseeable future. Do you understand? Government funding, because without funding, organizations or departments cannot operate. So the going concern may be threatened for an organization or a department or an entity of government where there are significant funding cuts. 2, financial sustainability. The auditor can consider financial sustainability. The auditor should assess the entity's long-term financial position, including operating margins, debt levels, and also cash flow, because unsustainable financial practices or inability to generate sufficient revenue may raise concerns or may affect the going concern of such an entity. Financial sustainability ought to be considered by an auditor when determining the going concern of an entity. 3, legislative changes. Legislative or regulatory changes. Changes in laws, changes in regulations should be considered. These are potential changes in laws, regulations, changes in accounting standards should be considered. These are changes that may impact the entity's operations or funding, and therefore unexpected changes can disrupt financial stability of a government entity. 4, public policy priorities. Public policy priorities. The auditor should analyze how changes in government priorities or public policies may affect the entity's funding or mandate, because shifting priorities could lead to reduced resource allocation, jeopardizing operations of a government department or institution. Public policy priorities can be considered when determining the going concern assumption in the public sector. 5, the economic environment, the social environment should be considered. Economic and social environment. Economic and social environment. The auditor ought to assess the impact of the broader economic and also social factors like economic downturns, social unrest, natural disasters, which can disrupt operations and reduce demand for services that are offered by a given public sector entity. 5 or 6, this is 6, operational efficiency and effectiveness. How effective is the entity? How efficient is the entity? Operational efficiency and effectiveness. The auditor ought to evaluate the entity's efficiency in using resources and achieving its objectives, because inefficiencies or failure to deliver on mandates can affect public support and future funding. So if an auditor is to determine the going concern of a given public sector entity, then he may, or the auditors may have to evaluate how the entity utilizes resources. So if there are wastages and inefficiencies, or if the entity fails to deliver on mandate, then that can affect future funding, operational efficiency and operational effectiveness. 7, management plans and strategies. What are the strategies of the public sector entity? What are the strategies? What are the plans? Does the organization have plans? Does it have strategies? That should be considered. The auditor should analyze the entity's plans to address financial challenges, the plans to improve efficiency, or even to adapt to changing circumstances, because robust and credible plans can mitigate the going concerns, the concerns of going concern. You understand? Management plans and strategies ought to be evaluated by the auditor. 8. Public confidence. Does the public have confidence in the public sector entity or even stakeholder confidence and, let me say, and stakeholder support? Public confidence and stakeholder support. The auditor ought to check or consider the level of public trust and support for the entity, as it can influence future funding and political will to sustain the operations of such an entity. You understand? Because candidates, a loss of public confidence can impact budget allocations, can also impact legislative priorities. Okay? So these are 8 factors an auditor should consider in determining the going concern assumption in the public sector. So these factors highlight that although public entities have statutory protection, their going concern is not guaranteed. As much as there is a law in place that upon which public sector entities and departments are formed, that is not a guarantee that the public sector entity will continue operating in the foreseeable future. And auditors must thoroughly assess their financial sustainability, must assess the external environment, must assess the future plans that the organization has, provide an informed decision so that the auditors can provide an informed opinion on the ability of the entities to continue as a going concern. So these are 8 factors. 1, government funding reliance. 2, financial sustainability. 3, legislative and regulatory changes. 4, public policy priorities. 5, economic and social environment. 6, operational efficiency and effectiveness. 7, management plans and strategies. 8, public confidence and stakeholder support. So all these factors can affect the going concern of any public sector entity. And therefore, when the auditor is carrying out his or her audit, he must consider these factors in determining whether an entity is a going concern or not. That is question 2A. Question 2B reads, describe 4 procedures that an auditor might perform to identify subsequent events occurring after the financial year end in a company. Procedures an auditor should perform. What are the procedures for identifying subsequent event? What should the auditor do to identify subsequent event? What are the procedures? 1 is to inquire from management. Inquiry, right? Inquiry of management. This means just talking to the management, asking questions. Ask questions regarding subsequent events, because managers are ones who are in charge with the operations of an organization. So if an auditor would want to identify subsequent events, then it becomes obvious. Talk to the management. Discuss with the management whether any significant events occurred after the reporting date that may affect the financial statements. Why? Because the management has a responsibility to disclose such events. Discuss with the management. Ask questions. Inquire. Are there any subsequent events? So that is a procedure an auditor can perform to identify subsequent events. 2 is review of external sources. Review of external sources. The auditor can monitor news